Good morning, students. This is the BoS for Success session for final paper 7, Direct Tax Laws and International Taxation. I'm CA Priya Subramanian.
Good morning, students. Welcome to this BoS for Success session. I'm Aparna Chauhan.
So initially, we will be covering the important things like what is the syllabus, what is the study material, what is the applicable assessment year, relevant provisions of the Finance Act, and those things applicability, then your section-wise weightages, then time management, a little bit about the time management. And after that, we will be taking up some important chapters, important topics which have been amended or new provisions which have been introduced by the Finance Act 2022, which is applicable for May 23 examination. So let us start now. The syllabus of the paper is Direct Tax Laws and International Taxation. There's a clear-cut marks division between Part 1 Direct Tax Laws and Part 2 International Taxation. Part 1 Direct Tax Laws is for 70 marks and Part 2 International Taxation is for 30 marks. There are 3 modules for Direct Tax Laws and 1 module, Module 4 for International Taxation. And supplementary study paper, study material 2022. The October 2021 edition of the study material has to be read along with the supplementary study paper 2002. Supplementary study paper 2002, it contains all the amendments by the Finance Act 2022 and circulars notifications issued up to 31st October 2022, which is the cutoff date for May 23 examination. So it contains that, and that has also been divided chapter wise in line with your study materials in order to facilitate you to read it along with the relevant chapter. So in that study, supplementary study paper, it's been web hosted at the BoS knowledge portal. It's available there. Some chapters where there has been lots of amendments like charitable trust, dispute resolution, advance ruling. Advance ruling amendment is because the AAR ceases to be relevant and now it's the BAR. So the earlier study material contained both. So now we've given you only the relevant provisions of BAR in the supplementary study paper. So in these 3 chapters, it will entirely substitute the content in the study material. As regards the other chapters and all, wherever the provisions have undergone major changes, so we've given the relevant provisions in entirety, and you would have to substitute in the place of the provisions of the study material. In some places where there are minimal amendments, then we have told you what the amendment is and how to go about studying in each case, whether you should read it along with the study material or whether it's in substitution. We've given it the relevant places. Also further, if there are some questions which have become redundant, for example, in advanced ruling, that also we have mentioned it in the relevant place in the supplementary study paper. In fact, the supplementary study paper contains in the beginning, before we begin. So that clearly explains how the amendments have been presented. You must go through that before you read the supplementary study paper. In fact, the first query which has come from Mr. Venkatesh Kamath, he is asked regarding RTP contains question on virtual digital asset, which chapter of the study material it has been discussed. So it is because it's a latest amendment, it's a new provision. It has come in the supplementary study paper 2022. It has come in assessment of various entities chapter. So please go through that chapter. We'll be discussing that question in our session today also. So supplementary study paper is extremely important. And then as regards judicial update contains the latest case laws that has been web hosted at the BoS knowledge portal. The RTP contains a link to the judicial update also. And in that also, some cases given in the study material has been no longer relevant because of the subsequent ruling that has been mentioned. So everything is clear. So supplementary study paper 2022 as well as judicial update are very important. That will give you the provision of law as is applicable for the examination. So it is very important that you study that. In addition, we would like to mention that the MCQs and case scenarios relevant for May 23 and November 23 examination have also been web hosted at the BoS knowledge portal. MCQs have been separately web hosted, case scenarios have been separately web hosted. You are advised to work out all these questions on your own. First, you read the study material along with the supplementary. So keep it side by side. Your supplementary should be along with your study material so that you read the amended provision all in one go along with the judicial update also. So once you do that, then after you do all the chapters, once you complete your study, thereafter do the MCQ and case scenarios on your own, solve it. and then compare it with the given answers. Only then you will be able to identify where you've gone wrong. In case you're not able to get the answer, revisit the provision. It's something which you've not understood correctly. Revisit the provision in the study material, go through that and attempt the question again. Apart from that, descriptive questions are there in your RTP. It's there in your, one MTP has already been released. One more will be released so that you can practice. You have adequate practice.
Yes, students, since you feel that the direct tax law is a very vast paper, it contains a lot of the whole of the Income Tax Act, right? And you feel you have to study a lot many things. For that purpose, now you can, strategize your studies in such a way. We have a section-wise weightages also for both the parts. For part 1, direct tax laws, we have specified certain weightages to a particular sections. In that section, one section comprises of particular topics, chapters, right? So what you have to do, you should analyze that section wise weightages to understand that on what topics you have to put a more emphasis, more studies which require, because in that case, in case some difficult question also comes, now you should not lose the marks from those sections, right? So in that way you have to study. So what are these sections? Let me show you that what are the sections which have a huge weightages. You cannot afford to skip those sections. You have to put a more emphasis. Whatever be the questions, you have to be very sure that you should be aware to answer that question. You should able to answer that question, whatever be the situation, whatever be the difficulty level of that from that section, you would be able to answer that question. That should be the way you have to study for those sections. Like for example, section 1 is a huge section, right? It gives a weightage of 35 to 45%. It comprises of many chapters, suppose from chapter 1 to chapter 12, right? From assessment of various entities. It has a huge weightage, and this chapter, have an effect on other sections also. For example, if you study this section from chapter 1 to chapter 12, assessment of various entities, computation of total income of companies, computation of total income and tax liabilities of firms, AOP, BY, many things are there in this particular section. But for non-resident taxation also, you must be knowing the provisions of the sections which are covered in this particular chapters, right? It assigned a weightage of 35 to 45%. You should go and read this section very properly. Practice the questions given in the study material, given in the TPs, given in your MTPs. Practice more things. Do the practice of these MCQs or whatever be the provisions covered in this chapter. Like for example, section 2. Section 2 is wholly on the charitable trust and religious trust, right? It is one chapter only. It is given a weightage of 5 to 10%. A question must be there for 8 marks from this section. You go through this, only one chapter you have to study, and you will fetch a mark of 8 marks. At least you can fetch 8 marks. Right? Your 8 marks are confirmed from this section. Like in case of chapter 15, whole chapter is being given a single section. It is of weightage assigned a weightage of 15 to 20%. Comprises of TDS and TCS provisions, advanced tax and all. So these are not very difficult provisions also. You should study them thoroughly. You understand whatever the circulars, notification, judicial updates, anything, whatever be given in this chapter, go through careful each and everything. You will fetch a good marks from this chapter, right? It will also come to around 8 marks. You will get a descriptive question. Some of the MCQs, the question being asked in the form of MCQs also from this section. Like in case of this chapter 22 miscellaneous provisions, also some of the topics are very relevant. Like for example, 269 ST, 269 SS. These are the very relevant topics. You should go through them very carefully. Right? These are you can plan your study according to the sections, according to the weightages assigned to a particular topics. In that way, you should plan your studies. You should be affirm that I will get the whatever be the weightages, whatever be the marks, whatever be the type of questions being asked from this section, you will get a full marks from this. In that way, you will have a good score. Likewise, for part 2 also, there is a separate weightage has been assigned for chapter 5. 5 chapters are combined in this one section, which is given a weightage of 75 to 85%. So if you do these chapters thoroughly and properly, transfer pricing, non-resident taxation, one question must be there for non-resident taxation. Some MCQs also may be asked from this non-resident taxation. TP provisions are there, 92 CE, 94B. These are very important sections. You should read these sections very thoroughly. DTA, one question must be there on DTA, advanced ruling. Now it's board for advanced rulings, equalization levy. So these, you should practice these chapters very much, too much, because if you have a proper studies from these chapters, then you will be able to score at least 24 marks, right? From the other section, there are 3 chapters, chapter 6, 7, and 8, and one knowledge based question must be there from this second part of the section. So knowledge based, 6 marks question must be there, or 4 marks question, or some MCQs form may be asked. So you should accordingly plan your studies, right? According to the weightages assigned to the particular chapters.
In non-resident taxation, you must be particularly careful because there are so many special rates in that. Special rates accompanied with certain conditions, like special rates might be accompanied by a condition that it has the gross, it'll be on the gross income. You will not be allowed any deduction from that particular, while computing expenses are not allowed as a deduction. Or suppose in some cases, like capital gains, you might get the expenses as on transfer as a deduction, but you might not be getting indexation benefit. So if there's a special rate, what is the condition attached to it? So that is very important in case of non-resident taxation. And definitely there'll be a question on non-resident taxation. And the provisions I've asked, there are TDS provisions also in non-resident taxation. That also you will have to keep in mind. There you have to deduct along with surcharge and cess if applicable, whereas for residents you don't add the surcharge and cess. So all these finer points you have to keep in mind in case of non-resident taxation. But the thing is, it's only one module and 5 chapters from which you can get an assured 25 marks if you're thorough with it. Just keep that in mind, like if you get 25 marks, but just reading 5 chapters that way. And even in the section 1, in TDS, TCS chapter, it's going to fetch 15 to 20% of 70 marks. So that is quite a number for just one chapter. So those things you must pay more attention. And initial chapters 1 to 12, definitely, that forms the basis of everything. Your compulsory question is there on that. Additional question is there. Scenarios are, maybe there are scenarios or independent MCQs, whichever that it might be there. So it carries such a high weightage that you must pay more attention to these chapters. And other chapters also, at the same time, you must take care of the important provisions in all the other chapters, that you must not leave out the important provision. You might sometimes get a straightforward question from the other chapter also, something which is based on an illustration or question given in the study material. So your study manner of preparation it's very important. You have to study well and study smartly also.
Yeah, smartly also. Generally, ma'am, when the students keep on asking how to prepare for the MCQs based question, how to prepare for the descriptive question. So we always say that the preparation is strategy for both the types of questions. It's a manner of asking the question, right? Will not change your preparation strategies, right? Whatever be the way you are studying for your descriptive question, you have to study for the MCQs also. But you have to, of course, keep in mind in MCQs, you need not to give the reasonings. But in descriptive, you have to give the reasonings proper. You have to substantiate your answer with the proper provisions, analyze the provision, then you have to write accordingly. In MCQs, but if you've gone wrong, then you will lose all marks, right? So you have to be very careful while attempting the MCQs portion. In descriptive, step-wise marking is there. In case some step gone wrong, then you will definitely fetch some of the marks from the descriptive portion. So this is the thing, preparation into strategy must be same for MCQs questions also and for the descriptive also. You have to keep in mind, but you have to be very careful by attempting the MCQs question. Read the question very carefully, read all the options. You should not, in hurry-burry, you should not select some wrong option, right? Which is not correct. So you have to analyze the question very carefully, read the requirement, read all the options of the MCQs also before choosing any of the options. So,
and then Prasad has asked the question like, what about case law based question where they ask you to describe the issue, provision, analysis, and solution? See, generally these questions come for 4 marks. So issue is what you get from the question itself. Provision is what the provision of law, which section you're going to apply, which section. Normally it's a section or a subsection or a particular thing which you're going to apply. That is what you have to mention there. Analysis, it will be based on a particular case. So you have to analyze that, write it in short. there. What really matters for the case on hand, that you have to consider. The case law might be big, it might cover 2-3 situations, huge analysis will be there, but ultimately what is relevant for answering this question and considering that will carry 1 mark only, your analysis portion. And conclusion, of course, you have to write whether, suppose they ask, what is the contention of the AO is right or not, then on that basis, you have to write that. So it is generally for 4 marks. And since it's a subjective, it's very subjective. Now, your best answer might fetch you only 3 marks because there's a lot of subjectivity in this particular type of question. Na? So that's what, like if it's a computation, if it's a computation of total income or a non-resident computation, if everything is right, your reasoning also you've mentioned briefly, then you can get full marks also in this. But in this case law type of questions, that because of the subjective element involved in that, you might get 3 out of 4 for a best answer. This you have to keep it in mind.
Yeah, while writing the issues, now you should not write the question itself. You have to analyze what is the issue involved in that question. You have to analyze that issue and then you have to write. Right? According even the steps you have to follow, that you have to analyze what provisions are applicable, right? That particular provision. Then you analyze based on the provision itself. You have to analyze what is the issue, how you will resolve that issue, applying that provision and applying the rationale of the case law also. One question when the students keep on asking, don't write wrong citation of the case laws. If you are not remembering or not able to recall the citations of the case law, you just write as decided by the High Court, as the Supreme Court. At least if you are remembering that portion, then you should write that one only. But don't try to write something wrong.
Wrong name.
Wrong
name of the party.
The wrong section you should not put. If you are remembering the section number, very confirm, yeah, this is the section number, then you should write. But as a final student, we always keep on saying that try to read the, understand the concept with the help of the sections. In that way, you will able to better understanding. You have a better understanding if you, read along with the section. Yeah, this section was section 80C. 80C is for this purpose. 80D is for this purpose. Section 11-12 is for charitable trust. Section 40A3 is for cash payments and also. Is because if you try to learn the things, now you will remember it for a longer time.
Yeah, it will help in easy retention.
Easy retention also. So don't write wrong section. If you remember, then you write it. Okay, these are the things. Now we will tell you what is this general question paper pattern of the this paper. This is the general pattern which they are following over the years. That for direct tax law 70 marks means in case of section 1, there must be a compulsory question for 14 marks from section 1. It may be asking you to compute the tax liability of a company. Compute the tax liability as per the applying the provision of section 115BA, concession tax assignment. You have to read the requirement of the question very carefully. It's a 14 marks compulsory question. You cannot avoid it. And while answering this question, you have to, give the reasoning also. Before doing any kind of adjustments, write a brief reason then and there in the adjustments. Right? Don't, whatever, when you are computing the total income, whatever, you have to substantiate your reasoning. That what the treatment of that particular adjustment. This is compulsory question. It is maybe on the company's corporate liabilities or on the firm basis. Then second question also, second questions will be having 2 parts. It's 8 marks from part 1 or part 2 from 6 marks. 6 marks from part 2. So part 1 also maybe from this section for 8 marks. Testing the MAT provisions, testing the AMT provisions, testing the AOP firm provisions. So this 2 questions will be from this section 1. And again, if in case of tax planning, suppose they want to test the individuals, whether the individual should opt for section 115 BAC or not, then again it is from this section only. But of course, it will ask from will cover in this tax planning section, right? So that question also from this section can be asked. GAR provision is something different from tax planning. You have to read it other than this. But individuals key, whatever the tax planning may be asked based on it will be based on from this section. So this is from section 1, descriptive portion.
First question, compulsory question is a very scoring question generally. See, even if you don't know 1 or 2 items of adjustments, whatever you know, you write properly and support it with proper reasons. Then that will definitely fetch you all the step marks. And sometimes, the treatment given would have been correct. So you don't make any adjustment at all. But even then, give one line of reasoning why you're not making the adjustment. Because it's been correctly debited. What it has to be correctly debited or correctly credited to P&L account. It falls under the head PGBP and it's been correctly credited to P&L account, so no further adjustment is required. So that one, if you write it, even if no adjustment is required, you write a line for that. You need not stretch it too much. Like you need not write lengthy thing, because each adjustment at the maximum will carry half mark or 1 mark. So it has, but it needs a reasoning. Simply, if you're going to make additions and subtractions without reasoning, that will not fetch you marks. So along with the reasoning, it should be that the reasoning can be brief and to the point. And it's a very scoring question. One of the most scoring questions in the paper on direct taxes.
So one case scenario based question also can be asked from this section. Some independent MCQs can also be asked from this section, right? So it carries a huge weightage, this section. Then the second question, I already told you, it will be having two parts. That part 1 from part 1, 8 marks, then 6 marks is from international taxation. Then in section 3 again, from section 3, there will be some MCQs based question can be asked, or one descriptive question for 4 marks can be asked from this section. Then from section 4, it is again 15. This is deductions chapter, deduction and collection. So some case scenario or some independent MCQs from question may be asked from this section, or some descriptive question of 8 marks may be asked from this section, from TDS and collection and sources. Then from this section 5, this is a huge income tax assessment procedure. See, assessment for new provisions are being brought in this year, updated return, or this income escaping assessment is not current year provisions. Last year they have amended the whole of the procedure to do the assessments in case of such assessments, and everything they combine together. So from these sections also they will be asked. They can ask for descriptive question, or in the form of some MCQs, some question may be asked from this section. Then again from section 6, it's from liability and special cases and miscellaneous provisions. Some of the questions of 4 marks in the form of 4 marks and descriptive form they can ask, or some MCQs from this section are quite possible to be, can be asked from this section. Then part 2 again, part 2 में part 5 comprises of 5 chapters. From that, 4 of the questions are based on this, from descriptive portions, and some of the MCQs can also be asked from this these 5 chapters, right? And in the second portion is generally knowledge based questions are being asked from these 3 chapters, last 3 chapters, and they may be asked in the form of a descriptive form or in the form of a MCQs. MCQs portion is for 30 marks, is fully compulsory. You have to attempt all the MCQs, and remaining 70 marks is in the form of a descriptive question. So this is the paper pattern which we are following. We are being following over the years.
Okay, now another important thing which we notice is many students say they're not able to complete the paper on time. So they are not able to complete the paper on time. DT paper is very vast and all. So it's important that you make plan your time at the time of writing. One is your preparation should be adequate. If your preparation is not adequate, then it becomes very difficult, for time management. You might not know, even if you have time, you won't know. So with adequate preparation, after that, how do you manage your time? You have a total time of 3 hours. Sorry, 8 minutes. 3 hours, 180 minutes you have in total. Prasad, actually, today in our session, we will be primarily focusing on the latest amendments, because those itself are very huge. When we go into the technical things, those things, new amendments are some things which students are not familiar. So, and we have a time of 2 hours. So we'll be mainly focusing on that. Whatever are the existing provisions, there are adequate number of illustrations in the study material itself and in the past year's things. So I think that from there you can go. In case you still have doubts, you can write to us in the mobile app and we will answer that query to you.
No such amendment is there.
So 180 minutes is a total thing. 30 marks are for MCQs. See, MCQs, you don't require reasoning. Of course, there also you'll have to spend adequate time, because you can't afford to give the wrong answer. It's a very scoring thing, but it may be, some of the MCQs may be difficult, because there will be a balance. Some will be difficult, some will be moderate. So accordingly, you will need time for that, but ensure that you complete that within 45 minutes. Don't give more than 45 minutes for your MCQs. 45 minutes should be adequate for 2 case scenarios and the remaining things, because you don't have to give reasoning for that. Okay. So remaining, how much you have? 145 minutes. Now in 145 minutes, I have to attempt a compulsory question for 14 marks. And then out of the remaining 4 questions for 14 marks, I have 5 questions, sorry. Remaining 5 questions. One compulsory question. And then remaining 5 questions, I have to choose 4 questions. And each question for 14 marks has 8 for direct tax laws and 6 for international taxation. Okay. So totally 1 compulsory plus 4 optional 14 marks questions. So 5 questions, descriptive questions at 14 marks, which requires adequate time. How much time do I have? 145 divided by 5. 5 2s are 10. 5 2s are 10, 5 9s are 14. 29 minutes. 145. I think it is wrong. It's 135 minutes I have. 180 minus 45 gives me 135. 135 divided by 5 gives me 27 minutes. Okay, 27 minutes per question I'm having. Let us take it as 25 minutes per question. Okay. Now, if I have 25 minutes per question, I have to complete my compulsory question within 25 minutes. Sometimes if it takes 30 minutes, then remember, if this compulsory question, instead of 25 minutes, you take 30 minutes. Then the time available for the remaining questions, that will get further reduced. So 25 can become 30 for the first question, but don't allow it to become 40, 45. Because then you will definitely not be able to complete the paper, because you feel the first question, let me do very well, and so let me get in, and you spend 45 minutes in the first question, then you will not be able to complete the paper, unless it so happens that you don't know one question in totality. Then it's a different story altogether. But I am presuming that you know adequately to attempt all the questions. In such a case, you should not end up spending more than 30 minutes per question, even if some question, because first question happens to be difficult, or it's because you take 30 minutes. Till 30 it's permissible, but then keep in mind your for other question, instead of 27 it will become 25. Okay, 25 minutes only you will have. And that 25 minutes, what happens if that 25 minutes for other questions? Yeah. Now I have 25 minutes for the other questions. Now, each 14 mark question, as I said, comprises of 8 marks in DT and 6 marks in international taxation. So how do you do this 25 minutes? 15 minutes should go for DT. According to the marks allocation, I'm telling 10 minutes for international taxation. This is how it should be for each question. And this 8 itself might be further divided into 2 parts. It is possible that this 8 also can be divided into 2 parts. Accordingly, the 15 minutes also you will have to further divide it into 2 parts. So your timing, you have to be very careful how you do it. What happens sometimes, your international taxation tends to be difficult. So it might be difficult for you to complete it within 10 minutes. It might take more than 10 minutes. The calculations might be a little bit more. Suppose you end up taking 15 minutes for that. Accordingly, you have to see how you will adjust it in the first part of it. It so happens that sometimes we've observed that it may become difficult. It may not be lengthy, but it might be more, it might involve more application and all those things. So it might end up consuming more time. So you have to keep all this in mind. So in MCQ portion, in fact, instead of 45, if you can complete it in 40 minutes, it will be very, very good. You will have that 5 minutes spare, so that some difficult question in your descriptive portion, you can afford to take a little bit more time. So ideally, if you complete it within 40 minutes, it's very good, but don't take more than 45 minutes for MCQs. Ideally, 40 minutes, if you do it, you will have some spare time for any difficult questions. Definitely 1 or 2 questions will be difficult. All questions are not going to be of moderate level difficulty. It will be, paper will be balanced. 1 or 2 questions will definitely be difficult. Other questions will be of moderate level difficulty at the final level. But if your preparation is good, then you will be able to attempt it. You will be able to attempt those questions. Of course, you might make mistakes, but ultimately, overall performance matters. Some mistakes, everybody within the 3-hour time when you have to attempt a paper, when there are so many provisions, it is very much natural that you will tend to make a few mistakes, but few mistakes should be restricted to few. That happens, like because of the time restriction and this thing. It should not be because of your lack of preparation. Your preparation should be 100%, so that you will be able to score 60 to 70 marks easily, which is very good in direct taxes. Okay, so be careful about your time management. In this way, if you do it, allocate this time management such that 14 marks question, MCQs you completed in 40 minutes, 40 to 45 minutes. First question you completed in 25 minutes, maximum 30 minutes. All other questions you keep 25 minutes. Try to do the DT portion in 15 minutes and international taxation in 10 minutes. If you can complete that 1 or 2, 3 minutes earlier, DT portion, that extra time you will have for the international taxation portion also. I hope this is clear. In this manner, you'll be able to complete it. And also be careful about all what the steps you are doing, all because you may not have time to revisit the question. So do everything very carefully. Read the figures and write the figures carefully. Don't miss out any zeros. Take care then and there because you won't have time to revisit the questions again.
Utilize your 15 minutes reading time.
Reading time carefully so that you attempt the question which you know best first. Suppose, see, you know question number 3 very well. You're able to do it. Then afterwards, you know question number 5. You keep that in your mind and attempt it in that order. But when you take up question 3 and attempt it, or attempt all the subparts together, attempt the DT and international taxation portion, complete it, and then go to the other question. That you can do on your own. But compulsory question, I would suggest that all of you be very well prepared for it and do attempt. Don't leave out the compulsory question because that's a very scoring question. Even if you don't know 100% of the amendments, you know only 80% of it, still out of 14 marks, you should be able to score 10 marks with good preparation.
Saurav Sarkar wants to thank us for congratulations, Saurav, for clearing your CA exams.
Hearty congratulations. And he has said that the previous BoS for Success session benefited him. Okay, so this will be a motivation for the students of this session. Pay careful attention to what we tell you in this session, and with adequate preparation, definitely all of you would be able to clear. All of you have a very good chance of clearing the examination with good scores. Okay, now we will go to the amendments actually. Basically, we are going to take up the questions in the RTP. They are based on the latest amendments, which are covered in the supplementary study paper. And basically, we'll be concentrating on the issues which we have dealt with it, because everything to do it exhaustively within the time span is not possible. So the issues which are dealt with in the question, the related provisions will be first explaining to you and then taking up the question and then solving the question. The case scenarios, both the case scenarios will be solving, MCQs will be solving. Descriptive questions are given, but 1 or 2 descriptive questions we will be taking up, which involves many provisions, a number of provisions. So those we will be taking up. So we are starting with charitable trust. See, there's been a major revamp in the provisions of charitable trusts last year. And that is why we've given the content, you know, the entire content we've given in the supplementary study paper, which will replace the content in your, this one. They've tried to align 1023C and 11 as much as possible. And some further restrictions they've put, you know, they wanted to tighten the scheme of charitable trust so that to prevent any form of misutilization, basically. So let's go ahead with the provision so that we'll be able to answer the case scenario. Okay. So first one is the amount credited or paid out of accumulated income. Here again, I'm presuming that you've all read the trust provisions, because if we start explaining from the scratch again, there won't be any time. So I presume you know what is current year's income, you know what is accumulated income, what are the conditions which you have to fulfill for accumulation. All those things you have an idea of. So on that basis, we proceed. Amount credited or paid out of current year income, out of accumulated income, sorry, of any trust to another trust registered under 12A, AB or approved under 1023C 4566A, not considered as application of income. Okay. There are 2 things now. Then the next one also I will read. Amount credited or paid to another trust, registered trust or institution out of corpus donations not to be considered as application. So consequently, what we derive is consequently amount credited or paid out of current year income of the trust, not being a corpus donation to any other trust or institution registered under 1212A or 1023C would be treated as application of income. So what is there basically? You have accumulated income. You have current year income. Out of current year, you have corpus donations. and other voluntary contributions. Okay. So now when I'm donating to another trust, okay, that out of accumulated income, it's not permissible. Current year also out of corpus donations, it's not permissible. Current year, other income out of other voluntary contributions, it is permitted. I can donate to another trust or institution out of current year income. Okay, that is one thing. Then the provisions of 40A1A, 40A3 and 40A3A apply in case of application of income by a trust. Okay, normally trust is a special scheme, but now it has been, there are special provisions which state that the disallowance under 40A1A for non-deduction of tax at source, that would apply in case trust has made any payment on which tax is deductible, but it has not deducted tax at source. In such a case, what is the normal provision? 30% will be disallowed in the current year. Later on, it will be allowed in the year in which the amount is paid, tax is deducted and paid. So that will apply in the case of trust also. Again, 40A3 payments in otherwise than by permitted modes like account pay check, account pay bank draft, electronic modes, ECS through bank account, if it's about 10,000, and if it's not been made through these modes, in the normal course, this allowance will be attracted when I'm computing PGBP income. Now it will be attracted in the case of charitable trust also. And 40A3A is on mercantile system, basically when the expenditure used to be allowable on mercantile basis. And this year, that also the restriction has come that it has to be on payment basis. But earlier it was allowable on mercantile basis, and subsequently you make a cash payment exceeding 10,000, then it will be deemed as your income. So that provision is also applicable in case of charitable trust. Then application out of loans and borrowings not to be treated as application of income. Suppose I borrow money from a bank and then I apply it for my charitable purposes only. Okay, only for charitable purposes I'm applying, but still it will not be treated as my application. So what normally when you get a charitable trust, what happens? Voluntary contributions are there, then other income is there, then you add it, then you provide 15% unconditional accumulation. The remaining amount, only when you apply it for the purposes of the trust, it will be allowed as deduction, otherwise it's not allowed. Now, what are not allowable as application? That is what we are seeing now. That is, suppose I don't deduct tax at source, then 30% will be disallowed. That I cannot claim as my application. Strictly speaking, if suppose there's a payment for 1 lakh on which tax is deductible and I have not deducted tax at source, then what is the consequence in case of a charitable trust? Only 70,000 will be allowed as my application, 30,000 will not be allowed as my application. And in case this 1 lakh payment, I've made it by cash, then entire payment will not be allowed as my application. I hope that is what, in the context of charitable trust, that amount will not be treated as my application. So amount, suppose I've taken a loan from a bank, loan of 10 lakh from a bank, and I utilize the 10 lakh for the purposes of my charitable purposes. Even though I've used it for my charitable purposes only, that will not be allowed as my application because it's not out of my voluntary contributions or income. It is out of a loan which is taken. So current year, I will not get the benefit unless I've repaid some portion. When will I get the benefit? This loan of 10 lakh, okay, this year itself I'm repaying 2 lakh. Then up to that 2 lakh, I will get the benefit of application. 2 lakh I can treat it as benefit. Remaining 8 lakh, whenever I'm going to repay it. Next year I repay 3 lakh, then 3 lakh I can take it as application. In that manner, you have to do it. That is also one of the recent amendments in the last couple of years. Then no set-off or deduction allowable for any excess application of an earlier year. Suppose last year I was required, my income was around 10 lakh, but I've applied 12 lakh last year. So I've applied 2 lakh. Okay, then that 2 lakh I cannot claim, set it off in the current year. It is not possible. That is not permitted. Then, of course, this has been there for many years. Like suppose the cost of the asset, both revenue and capital expenditure can be claimed as application. Suppose the capital expenditure, buildings itself have claimed it as application. Later on, I cannot claim depreciation again as application. Now, this is an important thing which has been dealt with in our case scenario. Last year, the Finance Act 2022 came out with this amendment. It inserted explanation to 11 stating that any sum payable by any trust or institution shall be treated as application only in the previous year when the sum is actually paid by it. Okay, this is irrespective of the previous year in which the liability to pay such sum was incurred or the method of accounting regularly employed by it. In short, what it means, only if I'm making the payment, actually I'm making the payment in the current year, it will be allowed as application. If suppose I'm just incurring the expenditure, payment I'm deferring it to a subsequent year, then I can treat it as application only in the subsequent year. I can't treat it as application in the current year. This is an amendment brought out by the Finance Act 2022. With effect from assessment year 22-23, this becomes very important. When this amendment came into effect, it was not from assessment year 23-24, which is relevant for your exam. What is the relevant assessment year for your exam? It's assessment year 23-24. But this amendment came with effect from assessment year 22-23. What does this mean? Last year also, if suppose the payment has not been made, the trust has just incurred the expenditure but has deferred the payment to a future date. Last year, the trust would not have got deduction of the said amount. It would not have got. Prior to that, assessment year 21-22, yes, it would have got. That time the provision was not in existence. So it would have got the deduction as and when it incurred the expenditure. But with effect from assessment year 22-23, only if the payment has been made, deduction would be available. Also, in respect of assessment year 21-22 and earlier assessment years, deduction was available when the the trust incurred the expenditure. In respect of that, the payment, suppose we receive it this year, then again I won't get a deduction because already deduction application has been claimed in that year. When this condition was not there, that time on accrual basis itself, the application has been claimed. So at the time of actual payment, this year again, we will not get it because it relates to assessment year 21-22 earlier. But if it relates to assessment year 22-23 or a later year, the trust will be getting the benefit only on actual payment. So if suppose this year I've incurred 12 lakhs, but I've made the payment of only 10 lakhs. So I can claim only 10 lakhs. Then in 2 lakhs, suppose I make the payment next year, then I can claim it as application the next year. I hope this is clear. Now coming to another important provision, these provisions I'm discussing because it has the impact on the case scenario, which we'll be taking up. So 13.8 is not a new provision. It's one of the existing provisions only, but it has a bearing on this case scenario. So that's why I'm discussing it. Charitable trust can be involved in education, medical or relief of the poor, and so many other objects are there. Last one is the residuary clause. Any other object, advancement of object of any other object of general public utility. So here there is an additional condition. It says that definition of charitable purpose under 215 provides that the advancement of other object of general public utility would not be a charitable purpose if it involves carrying on activity of nature of trade, commerce, or business, or any activity rendering of service in relation to trade, commerce, or business for a cess, fee, or any other consideration, irrespective of the nature or use or application or retention of the income from such activity, unless the activity is these are the exceptions, activities and undertaken in the actual course of carrying out of advancement of object and aggregate of receipts from such activity does not exceed 20% of the total receipts. If these two conditions are fulfilled alone, then it will be treated as a charitable purpose. So this condition applies only if the object of the trust is advancement of object of general public utility. Only in such a case, then if you carry on any trade, commerce, or business, and then that has to be related to the object of advancement of general public utility, and the income from such activity should not exceed, the aggregate receipts from such activity should not exceed 20% of the total receipts of the trust or institution. If it is within 20%, then the trust will not lose its charitable purpose. If it exceeds 20%, then it will lose its charitable purpose. Then what will happen? It will come under the special provisions of 1310 and 1311. That we will be discussing later. What if suppose it becomes beyond 20%, goes beyond 20%, then it will not get the benefit of 11 and 12. Then it will be taxable under 1310 and 11. So what is 1310 and 11? That will go through. So there are some stipulated conditions. The trusts for claiming exemptions, we've seen this so many conditions for claiming exemption under 11 and 12. 11 and 12 is what? Basically, you get a 15% unconditional accumulation, and the remaining 85%, when you apply it, you get the benefit of application. remaining apply it for the purpose of trust, or you accumulate it by filing Form 10 on time, and you can accumulate it for a specified period of time following the due process laid down by law. Okay, but then suppose I fail to fulfill some of the conditions. Like one of the conditions is, in case of an object of general public utility, my trade receipts amount to more than 20%. Then what happens? Then 13, 10 and 11 provides the manner of computation in such cases. I don't get the benefit of 11 and 12, but yeah, I can get the benefit of deduction of revenue expenditure. Otherwise, in the normal course, I get revenue capital expenditure, I get 15% unconditional application. But if I fail to fulfill the stipulated conditions, then I allowed only deduction of revenue expenditure. Now, what are the violations? One is, it has receipts of trade and commerce while advancing object of general public utility in excess of 20% of the total receipts. That is one of the conditions, the violations. Other violation, failure to maintain prescribed books of accounts. Whatever books of accounts have been prescribed, that the charitable trust has not maintained, or it fails to get the books of accounts audited and furnish the audit report. That also is a violation. Then it fails to file the return of income within the stipulated time under 139(4)(a). All these four are violations. Having excess of 20% of total receipts, that's only where a trust has an object of general public utility. Failure to maintain prescribed books of account, failure to get the books of accounts audited, file the audit report, furnish the audit report, and failure to file return of income within the stipulated time. In case of these violations, then only the revenue expenditure will be allowable. Capital expenditure is not allowable. And even then, there are certain restrictions. These are restrictions normally, which are, most of the restrictions are there in case of the normal 11 and 12 regime itself. Like, it should not be from any loan or borrowing. It should not be out of corpus. This condition is there for normal thing also. Normal provisions also, that suppose a corpus donation, what happens in case of a corpus donation? It will be exempt only if you invest it in modes specified in 11.5. 11.5 has many modes, like you are invested in a post office deposit account. There are many modes prescribed. Only if you invest it in those modes, the corpus donations will be exempt. If you don't invest it in those modes, it will not be exempt. Okay, or once I invested in a post office saving, I get the exemption under 11(1)(d), but thereafter, if I withdraw some amount from that and then I apply it for charitable purposes, that will not be treated as application, because already it is exempt. And the first hand itself, the corpus donation is exempt. So any amount which I withdraw and use it for my charitable purposes, that you cannot claim as application. Subsequently, if you replenish it, then at that point of time, you can claim it as application. But here, what they are trying to tell, this is a condition which is there under the normal provisions also. They again stated that same condition for claiming revenue expenditure, that it should not be from corpus donations. Then it should not be from a loan or borrowing. This is applicable for normal provisions also. Then you cannot claim any depreciation on the assets. If the cost has been claimed in any previous year, you can't claim depreciation in this year also. Then such expenditure is not in the form of contribution or donation 20%. Here, this condition is not there in 11 and 12. 11 and 12, you are permitted to contribute to another trust or institution, provided it's not out of corpus donations, it's not out of accumulated income. Out of current year income, you can do it. But when you're computing under 1310, this is not allowable. You cannot claim this as a revenue expenditure, contribution or donation to any other trust. This is an exception. I hope you people are following. Probably when I do the case scenario, it'll become more clear. So what you have to keep in mind, capital expenditure is not allowable as deduction. Then those disallowance earlier I told you under 40A1A, 40A3, 40A3A, all these disallowances will apply here, even in respect, even though only revenue expenditure is allowable, these disallowances will apply where income is computed under 13, 10 and 11 also. I hope this is clear. Then 115 BBI. 115 BBI has been inserted by the Finance Act 2022, and that provides for rate of 30% on specified income. Further, no deduction in respect of expenditure or allowance. A set-off of loss would be allowed while computing the specified income. So you won't be allowed any deduction or set-off of loss in respect of this income. What is the specified income? Specified income means income accumulated or set apart in excess of 15%, where accumulation is not allowed under any specific provision of the Act. Suppose it's allowed, like you're permitted to accumulate under the specified provisions, there are some conditions attached. Like suppose you file form 10, you will be allowed to accumulate. Or sometimes, like suppose you would receive the amount at the last day of the previous year, or then you're allowed to spend it in the immediately following year. So those are specified things where you have the permission, it's permitted by the Act. But sometimes when you, without filling form 10, if you claim the accumulation, that is all not permissible. In such case, such income will be taxable at 30% under 115 BBI. Also, even after you accumulate income, there are some conditions which you have to comply with. Like you have to apply it for charitable purposes. It should be in forms and modes. You have to invest it in forms and modes specified in 11.5. If you're not complying with these conditions, or after complying, then you remove it from 11.5 modes, or you accumulate it for other than, you apply it for other than charitable purposes, or you don't apply it at all. All these are violations. And when those violations are committed, then 30% tax is attracted under 115 DBI. That is, it's applied for two purposes other than charitable purposes, accumulations. Conditions specified for accumulations are because of which it becomes a deemed income. Ceases to be accumulated or set apart for application, ceases to remain invested or deposited in any forms or modes specified in 11.5, you're withdrawing it from 11.5 modes, then it's a violation. It's not utilized for the purpose for which it is accumulated or set apart. It's not utilized for that purpose. Then it's credited or paid to a trust or institution. Because this is not permitted out of accumulated income. Now you can't donate it to another trust. You can't accumulate it and thereafter donate out of that money. You can't donate to another trust. That is not permitted. And if that is done, then that is also a violation for which this will be attracted. 115 BBI will be attracted. Then income which is not exempt under 11 on account of funds of the trust being invested or deposited otherwise in forms and modes specified under 11.5. Then income which is applied for the benefit of a specified prohibited person referred to in 13.3. That is, who are the specified prohibited person? Like suppose it's a trust, it's an author of the trust, or founder of the institution, or the trustee of the trust, or a relative of all these people, or a institution in which these people, concern in which these people have substantial interest. All these are list of prohibited persons. So if any income is applied for the benefit of this person, it's a violation. It is subject to tax at 30% under 115 BBI, and penalty is also attracted. So it should not be applied for the benefit of any specified prohibited person referred to in 13.3. All these are violation, and if suppose some part is applied, suppose 2 lakhs is applied for that, then that 2 lakhs becomes chargeable to tax at 30%. Now coming to this 13.3, income of the trust inuring for the benefit of a person referred to in 13.3. Then what happens? As I told you, it's subject to tax at 30% under 115 BBI. Okay, and then penalty is also attracted under 271 AE. You know that this provision is to discourage trust. Don't apply it for the benefit of the founder, author, or their relatives, or the concerns in which they are substantially interested. If you do so, you have to pay tax at 30%. Also, penalty will be attracted. What is the penalty? First time it comes to the notice in a particular financial year, then 100% of the aggregate amount of the income so applied. Where the violation is noticed for the first time during any previous year, it's noticed again. Second time means then it's 200% of the aggregate of income so applied. So there you have to be very, very careful. So not only would it be subject to tax at 30%, but also penalty under 271 A would be attracted. Then non-applicability of relaxation under 56.210. 56.210 may, whenever a person receives any amount as a gift and all, then it will be subject to tax under 56.210, but there are some exceptions. Like when you receive it in the occasion of your marriage, when you receive it from a relative and all those things. Likewise, one of the exemption is when you receive any amount from a trust or this thing, then it is exempted in the hands of a person, trust registered under 12A or AB. Here again, they are telling this relaxation is not available where sum of money or property is received by specified persons. That is the author, founder of the trust, their relatives and all. If money is received by them without consideration or for inadequate consideration, in such a case, this benefit of exemption will not be available to these people. So these are the broad provisions which are important. I mean, some of them may not be tested in this scenario, but since they were related provisions, I had just taken it up. Now we come to this case scenario in the RTP. Helpage is a charitable trust registered under 12AB with the main object falling under the residuary clause, any other object of general public utility. Because this is why I had taken up that special provision also. During the year, it received 80 lakh as voluntary contributions. And the trust also borrowed for 40 lakh from Indian Bank to purchase land for construction of office building from where it carries out its function. So 40 lakh is a capital expenditure. Normal course that is also allowable as application, but here it's a borrowing from a bank. So it will not be allowed as application because it's out of loan taken from a bank. The trust repaid principal of 10 lakh to Indian Bank on 31/3/2023. So to the extent of repayment, it will be allowed. To the extent of 10 lakh, it will be allowed because it's repaid in the same year, 31/3/2023. Trust incurred revenue expenditure of 17 lakh and capital expenditure of 60 lakh towards purchase of land for construction of office building during the previous year, 22/23. So revenue expenditure it has incurred and capital expenditure of 60 lakh it has incurred. Out of the revenue expenditure of 17 lakh, 15 lakh was paid during the previous year, 22/23 itself. So 17 lakh is the amount incurred revenue expenditure. 15 lakh was paid during this year. Out of the remaining 2 lakh, 1 lakh was paid in April 2023, 1 lakh was paid in Jan 2024. That falls in the next year, financial year 23/24, assessment year 24/25. Okay. Now, during the previous year 22/23, the trust also paid 3 lakh towards revenue expenditure incurred during the previous year 21/22 and 1 lakh towards the revenue expenditure incurred during the previous year 2021. Okay. Trust also received 30 lakhs by way of corpus donations, out of which it deposited 25 lakhs in the post office savings bank account. Balance in the post office savings account after such deposit is 32 lakhs. That means earlier also it had 5 lakhs. The trust withdrew 5 lakhs from post office savings bank account and applied it towards the purchase of land for construction of office building. So 5 lakhs it has withdrawn towards purchase of land for construction of office building. The trust donated to EduAid, another trust registered under 12AB with the main object of providing relief to the poor, 12 lakhs out of its current year income. Out of current year income, it's permitted, there's no problem. Trust applied 2 lakh out of its current year income for medical treatment of the brother of trustee who met with an accident while working in his factory. So brother of trustee. So what will happen? This is a specified prohibited person, relative of the trustee. So it's a specified prohibited person. 2 lakhs has been applied for the benefit of that person. That will not be allowed as application. It will be taxable at 30% and it will attract penalty also. Now let's go to the questions. What would be the application of the trust for the previous year 22/23, excluding unconditional accumulation of 15%, assuming that it has fulfilled the relevant conditions stipulated under 12A. So, what are the 3 types of expenditure here? One is the capital expenditure 60 lakh, one is the revenue expenditure 17 lakh. Application ke liye. These are the 2 expenditure, revenue and capital expenditure. Apart from that, what is it? Apart from that, donation to another trust, 12 lakhs. So these are the 3. 2 lakhs will not be allowed. 2 lakhs which is given for the medical, it will not be allowed. It is not treated allowable as application, plus it will be taxable at 30% and it will be penalties also leviable. So that cannot be treated as application. So apart from that, we have to consider the allowability of 17 lakh, allowability of 60 lakh and the allowability of 12 lakhs. These are the 3 things which we can treat as application of the current year. So let us start. So now let's take donation to EduAid, that is fully allowable. There's no doubt about it. Current year income 12 lakhs, it's not out of corpus donations. So 12 lakhs will be fully allowable here. So we can fill that up 12 lakh. As regards capital and revenue expenditure, we have to see whether all the criteria, whether all the rules of application are met. So capital expenditure incurred is 60 lakhs. Revenue expenditure incurred is 17 lakh. These are the information from the question. So how much is out of loan taken? Out of loan taken will not be allowed. So here 60 lakh towards construction, we have read that trust borrowed 40 lakh on 1/7/2022 from Indian Bank to purchase land for construction of office building. So the 60 lakhs is also purchase of land for construction of office building. So 60 out of 60, 40 is not allowable because it's out of loan. So balance is 20 lakh. Now we see in this loan also 10 lakh is repaid during the current year, 31/3/2023. So that 10 lakh we can take because it is at the time of repayment to the extent of repayment. So 10 lakh we can add it. That will be allowed as my application. Now I'm seeing what is going to be allowed as my application. So 60 lakh would normally have been allowable, but 40 lakhs was out of loan, which is not allowable. So I'm deducting that. Remaining 20 lakh is allowable. To that I add 10 lakh because that loan has been repaid. 40 lakh I've added, reduced before, that loan has been repaid. So that is allowable. So 20 plus 30 lakh would be allowable now. Now, there is another information. The trust withdrew 5 lakhs from post office savings bank account and applied towards the purchase of land for construction. So corpus donation, which is invested in 11/5 modes, that is post office savings bank account. Out of that, withdrawal is not permitted. And that withdrawal out of that will not be treated as application. So 5 lakhs when I withdraw and apply it towards purchase of land for construction of building, that is not allowable. That is included in the figure. The 60 lakhs is the total amount which is incurred. That includes a figure of 5 lakhs which has been applied, withdrawn from post office savings bank account. The same has been applied for purchase of land for construction of building. So 5 lakhs is not allowable. So I reduce 5 lakhs. So what is the amount which is allowable? It is 25 lakhs. Capital expenditure allowable will be 25 lakhs. Now let's come to the revenue expenditure. Incurred during 22-23 is 17 lakh. Amount not received during the previous year 22-23, 15 lakh was paid. Amount which is not paid is 2 lakh. 1 lakh was paid in April 23, I'll get the benefit next year. Again, 1 lakh was paid in Jan 24, that also I'll get the benefit next year. So 2 lakh I'll have to reduce. So balance is 15 lakh. Now here, an important thing what I told you, that payment, the requirement of payment in the current year itself for being treated as an application, it came by the Finance Act 2022, but with effect from assessment year 22-23. With effect from the previous assessment year itself. So last year also, for assessment year 22-23, when I was computing my application, when I was providing for application, there again I would have taken only the sum paid, not the sum incurred. So what would have happened last year? During the previous year 22-23, the trust also paid 3 lakh towards revenue expenditure incurred this year. Current year, it paid 3 lakh towards revenue expenditure incurred in the previous year 21-22. And 1 lakh towards revenue expenditure incurred during the previous year 2021. So this is assessment year 21-22. So this is assessment year 22-23. So for assessment year 22-23 also, the application was allowed only on payment basis. So the trust would not have got deduction for 3 lakh, which it incurred during the previous year 21-22, but was not paid during the year. It would not have been allowed in the assessment year 22-23. Since that is paid during the current year, in the year of payment, it will be allowable. So the 3 lakhs will also be allowed as my application in the current year. This is because of the amendment of law with effect from assessment year 22-23. However, for 1 lakh, it is with effect from 1 lakh was incurred during the assessment year 21-22. That year, this amendment was not there. This requirement that the amount should have been actually paid was not there in assessment year 21-22. So this 1 lakh would have been allowed in that year. So once again, at the time of payment, it would not be allowed. I hope this is very clear to you. Since the amendment was made with effect from assessment year 22-23, therefore, for assessment year 22-23, application would have been allowed only on payment basis. Since 3 lakh was not paid, it would not have been allowed as application for assessment year 22-23. Since it has been paid in the assessment year 23-24, we have to allow it as application in this year. Whereas 1 lakh during the previous year 2021, assessment year 21-22 would have been allowed as deduction in that application in that year itself, because there was no requirement that year that the amount has to be on payment basis. Therefore, that would have been allowed in the respective years. We cannot allow it once again on payment basis this year. So what I have to add back? 3 lakh. So 15 plus 3, 18 lakh will be allowed as revenue expenditure. So 8 plus 2, 10 plus 5, 15. Carry 1, 3 plus 2, 5. 55 lakhs is my total application. So the correct answer is B. I hope all of you are following. So 55 lakhs is the correct answer to this particular question. What would be the application of the trust? Now let me rub it off. Any questions you can? The next question is, if the trust does not get its accounts audited before the specified date, what would be the consequence? So this is one of the specified violations attracting 1310. There are 4 violations, 1310 and 11. What are the 4 violations? One is if it's advancement of object of general public utility and more than 20% of your receipts are trailing receipts. Then if you fail to maintain the prescribed books of accounts, fail to get the books of accounts audited and furnish the audit report, and fail to file the return of income on time. These are the 4 violations for which 1310 and 11 will get attracted. So now the question asks, if the trust does not get its accounts audited before the specified date, what would be the consequence? What was the consequence? As per 13, 10 and 11, what would be allowed, what would not be allowed? So that we have to see. We have already seen capital expenditure will not be allowed. Only revenue expenditure will be allowed, and donation to another trust will not be allowed. So no deduction would be allowed if the trust fails to get its accounts audited before the specified date. It's not correct. It's not that no deduction will be allowed. The deduction will be allowed of revenue expenditure. This is not the correct answer. Capital expenditure incurred on purchase of land for construction of office building would not be allowed. Correct? Yeah, this is the correct answer. But don't tick it as yet. Read all the options. Amount donated to edu-aid would not be allowed. This is also correct. Amount donated to edu-aid will not be allowed. Then read the 4th option. Both capital expenditure incurred on account of purchase of land and the amount donated to edu-aid would not be allowed. This is the most appropriate answer. Both capital expenditure is not allowed. Amount donated to edu-aid would also not be allowed. So this is the right answer, which is the most appropriate answer. Individually, these two are right, but since both the statements are right, there is a statement which includes both the requirements. Capital expenditure will also not be allowed. Amount donated to edu-aid also will not be allowed. What will be allowed? Only the revenue expenditure will be allowed in such a case. I hope this is clear. I'm not getting any questions, so I have to assume that it's clear. If you have any questions, please raise it so that I can clear it then and there. What is the amount of income which would be chargeable under 115 BBI? 115 BBI, there was many violations. As I told you, you're accumulating it for a purpose which is not permitted by the Act. Then out of the accumulated income, you're not utilizing it for the purpose for which you accumulated it, or it ceases to remain in 11.5 modes, that is there. Then, or you are not accumulated, ceases to remain accumulated, that is also there. And then anything, you are investing it in forms and modes other than specified in 11.5, that is there. Then you are applying for the benefit of specified person, that is there. A prohibited person, that is also there. So these are the many violations are there. Here in this question, what are the violations? 2 violations. One is, of course, you apply it for the benefit of a specified prohibited person, 2 lakh. That is one of the violation. The amount applied will be chargeable to tax at 115 BBI, under 115 BBI. Also, 30 lakhs is corpus donations. Only 25 lakhs has been invested in the 11.5 modes. The balance 5 lakh has been invested otherwise done in such modes. So that 5 lakh plus this 2 lakh, totally 7 lakh. Amount chargeable under 115 BBI. Now, what is the quantum of penalty which can be levied under 271 AE? Assume that the specified violation has occurred only once. See, 271 AE is only in respect of one of the specified violations in 115 BBI. That is application for the benefit of a specified prohibited person. That is the author, founder, or their relatives. In respect of that, it will not be allowed as application. That sum will not be allowed as application. It will be subject to tax at 30%, plus penalty will be attracted under 271 AE. And since it has occurred only once, for the first time, if the violation is noticed, then it is 100% of the aggregate amount. If more than once, after that the violation occurs, then it's 200% of the aggregate amount. In this case, since the specified violation has occurred only once, 2 lakh is the amount spent for the benefit of the brother of the trustee. So 2 lakh is the penalty. 100% of the aggregate amount so up. Then assuming that for the purpose of this MCQ, the trust has receipts of 22 lakh from trade, commerce and business in the previous year 22-23 while advancing object of general public utility, what is the tax consequence? So 22 lakh, it is from trade, commerce, business. This trust, object of this trust is general public utility. So what is the condition to be fulfilled? That only 20, it should not exceed 20%. It should be in the course of advancing the objective of general public utility. That is clear from the question itself. It's in the course of advancing object of general public utility. But is it within the 20%? That we'll have to check. For that, what is the total receipts? Total receipts will be voluntary contributions is 80 lakh as voluntary contributions we have. Then 30 lakhs as corpus donations. Once again. So it's 80 lakh voluntary contribution plus 30 lakh corpus donation. This will be 110 plus the receipts. You have to see it as percentage of total receipts. So this receipts also we have to add it back. So this is 132. So 132 ka 20% will be 26.4. 26.4. This 22 lakh is less than 26.4 lakh. So there's no violation in this case. So there's no violation. So in that case, what the registration would be cancelled since it has violated? No, this is not correct. Would not be cancelled, though the trust would be denied exemption? No. Trust would be denied exemption, entire income would be chargeable? No. Neither the registration of the trust would be cancelled, nor it would be denied exemption as it has not violated this stipulated condition. One is the trust has receipts while advancing the object of general public utility and it is within 20%. So the fourth option is right. Suppose this amount had been higher than, suppose say this amount had been higher than the 26.4. It had been 30 lakhs. Let us see. Then what would have been the answer? The registration would not be cancelled. Registration won't be cancelled. Then the trust would be denied exemption for violating the stipulated condition. Yes, it would be denied exemption under 11 and 12. And how would it be taxable? It will be taxable under 13, 10 and 11. 13, 10 and 11, wherein revenue expenditure will be allowed. Capital won't be allowed. Amount donated to another trust won't be allowed. Revenue expenditure, but disallowance under 40A1, 40A1A, you can't do it out of repayment of loan. All other conditions will apply. You get it? Suppose had there been a violation, suppose it had been in excess of the 20%, then option B would have been correct and it would have been chargeable to tax under in the manner, the total income would have been computed in the manner specified under 13, 10 and 11. I hope this is clear to all of you. Can we proceed to the next topic? All of you? Venkatesh, Prasad, Viraj Desai. These three are the ones who have been asking questions so far, and all the rest of you also. Anyone has any doubts in this, you may ask. Else we'll proceed without wasting time to the next topic, assessment procedure.
So, in assessment procedure, this is one of the provision which is being, one of the provision which is being brought, new amendment, new provision being brought in section 139, that is relating to updated return. As per section 139.1, there are 3 due dates are being prescribed. That is 31st July of the relevant assessment year, 31st October, and 30th November. There are 3 time limits for different types of assesses. In case of an individual or who is not required subject to tax audit 31st July in case of a company or a person who is required to get its account audited 31st October. In case of a person who is they are entered into an international transactions, they have to submit a transfer pricing audit report and all. In that case, 30th November. This is the 139 one up to which you have to file your return of income. Right? These are due dates. Further, in case if you are not able to file the return of income within this due dates, then you have an option that a belated return you can also file. That is the time limit given is the 30. This is 3 months prior to the relevant assessment year. This is the wordings of the provision as per section 139(4). For belated return, where in case you forgot to file your return up to the due date, you can furnish the return of income till 31st of December of the relevant assessment year. This relevant assessment year for you is assessment year 22-23, 23-24. So up to 31st December 23, you can furnish your return of income. See here, you have, and in case if you have made some mistake, you have observed that you have skipped something in your return of income, then you can correct it also. For that purpose, you can file a revised return. And for that also, you have an extended time limit of 31st of December. Up to 31st of December of the relevant assessment year, you can revise your return of income. If you have done something, you have noted something wrong which you have done in your original return, then you can revise it also. In that case, what is the extended time period you have? In case if your due date is 31st July, you have 5 months period time, right? And in case it's 31st October, you have 2 months period to file a belated return or to revise your return of income. In case if your due date is 30th November, you have only 1 month for doing the revision or to file the return after the due dates. So what government feels ki, see, government want ki you people, in order to avoid government obtain so many information for the taxpayers by way of statement of financial reporting, by way of reportable account. So the government have a lot of information of the taxpayers, wherein it is being noticed continuously that the taxpayers have the income which is chargeable to tax also, but the people are not declaring that income in your return of income. So instead of issuing notices, or instead of issuing or doing your assessments on something, what the government has provided, they have given you option to voluntarily disclose your income and pay the tax by filing the updated return. Okay. So updated return may you have the option to declare your income, even though if you have not furnished your return of income as per 139(1), 139(4) or 139(5), you have not done anything, even then you can furnish an updated return. This is with the objective to reduce the litigations, to reduce the compliance burden on the taxpayers, government feels, and for that purpose they have bring out with the concept of updated return. Earlier they have come out with certain kind of schemes, voluntary disclosure schemes, where it is for a particular period. Now they have made this provision in the Income Tax Act itself. In this case, what are the things you have to keep in mind? See, subsection 8 have been inserted in section 139. Whole of this section you have to read in 4 to 5 points. What are these points? That who can file an updated return? Who can file an updated return? कौन कर सकता है? A person who has already furnished a return of income, or a person who has not furnished a return of income. In this case, a person, even if he has not furnished a return of income as per section 139(1), 139(4), 139(5), then also you can you have the option to furnish a updated return. What is the time limit? Up to what time you can furnish your return of income? Up to what time you can furnish your return of updated return? कब तक कर सकते हैं? This time limit is being prescribed in section 139(8). We will see what is the time limit and in what circumstances. It also provides the circumstance. It is not giving an option to all the assessees who has not furnished their return of income, or who has not able to revise the return of income till the whatever the timelines been given in the act. They don't have the option. All assessors cannot come and file the updated return. there are certain restrictions also that only particular there are restrictions that if it is a return of income only, that means a per taxpayer who wants to pay the tax, it has additional tax liability, then only you will be able to file the updated return. In case if you want to reduce your tax liability, you forgot to claim your some deductions or exemptions you forgot to claim, then you don't have the option to come in the section 139(8)(a). There are certain restrictions. What is this? In case of there is a loss return, updated return is a loss return, then you will cannot file a updated return. If you want to decrease your tax liability determined based on section 139(1), 4 or 5, then you cannot come and file the updated return. If in case your refund is being increased by, if you want your increase as compared to the return of income filed under section 139(1), 4 or 5, then you cannot file updated return. These are the things. There are certain other circumstances also wherein a person cannot furnish a return of income. What are those circumstances? Those circumstances you have to remember. Then while filing an updated return on as a taxpayer is required to pay additional income tax. What is this additional income tax? How to compute this additional income tax? We will see these provisions in updated return. So first, who can file updated return? If you want to pay additional tax, if you have a tax liability, then you come and file your updated and declare your income. Voluntary disclosure scheme kind of thing it is, right? So if you want to pay, declare your income, instead of going into any kind of litigations and all, come and file your updated return. What is the time limit? You have the time limit for filing this updated return is from at any time within 24 months from the end of the relevant assessment year, right? Note the dates carefully. You have to remember these dates, right? What is the time limit? Only within 24 months. If you have, even if you have not furnished your return of income, or if you have furnished your return income also, after this 31st of 12/23, you have the option to file an updated return up to 24 months from the end of the relevant assessment year. For example, the relevant assessment year for May 23 exam is assessment year 23-24, right? Up to what time you can file? A person can file a updated return. It is 31st March 26. You can file this within 24 months from the end of the relevant assessment year. The relevant assessment year is ending on 31st of March 24. So 2 years you have. The assessee have to furnish a updated return. Loss return you cannot furnish. You cannot furnish a loss return. You cannot reduce your tax liability. Person cannot increase their refund by filing the updated returns. There are certain other circumstances also. In what circumstances they are being assessee is not eligible to file an updated return? You have to remember these circumstances, right? Based on these circumstances, they can ask you a MCQ also based on this circumstance, whether a person can furnish a return of income, updated return or income or not. A descriptive form of question can also be asked. What are these circumstances? In case of a person, where a search has been initiated, or where assets or are requisitioned under section 132A, a search being initiated under section 132, or books of accounts or other documents are requisitioned under section 132A, or where a survey has been conducted under section 133A. What is the exception? Remember this exception. It's very important actually. What is this exception? Where a survey is conducted in relation to a TDS or TCS regarding. They want to collect some information, want to conduct the survey for gathering the information relating to TDS and TCS. Then the person is eligible for file. However, in case of other cases where survey is conducted for other purposes, if it is conducted, then that person is not eligible to file a updated return. Or where a notice has been issued regarding it, then in that case, for that assessment year in which the search is conducted, or your books of accounts or other assets are requisitioned, then for that assessment you are not eligible. Plus, and it is and here. They are saying for any assessment year preceding such assessment year means that person will not be eligible to furnish its updated return, right? In that case. In other cases, what are the other cases? Where a person has already, once you have furnished your updated return of income, then for the same assessment year, you cannot again furnish the updated return, right? Where a person already furnished an updated return for the relevant assessment year, then that person cannot furnish its updated return again for the same assessment year, right? Then what is this? where any proceedings, it's important, where any proceedings has been completed in respect of assessment, reassessment, recomputation, or these proceedings are pending. Suppose a notice being issued under section 148 for doing the income escaping assessment. It means proceedings has already been initiated, right, for conducting the assessments. Then in case there's it is may not been completed, they are pending, then also you are not eligible for file a updated return. Important one. Everything is important, but these are the things you should remember. The assessment should not be completed nahi hona chahiye in respect of that assessment year, or some proceedings should not be pending also. Then you are not eligible. Fourth circumstances where an assessing officer has information in his possession in respect of a person under the other acts. What are these acts? Smugglers, foreign exchange manipulators, Benami Property Act, Money Laundering Act, Benami Property Act or Money Laundering Act, Black Money Law. If the assessing officer has some information regarding that person and that been communicated to the person before filing the return of income, then for such relevant assessment for which the information pertains to, you are not eligible to file the updated return. Now, what are the other information? In case information is have the information as per the agreement entered under section 90 or 98, then also you are not eligible for that particular relevant assessment year. In case of prosecution procedures are being initiated in respect of particular assessment year, for that assessment year also that person is not eligible to file a updated return. So there is a difference between the other remaining 4 clauses, 1, 2 and this is second, third, fourth, and fifth, sixth, right? 5 clauses are different for relevant assessment they are talking about. And for the search cases, the person itself is not eligible to file the updated return in case search is conducted or books of accounts are requisition or a survey is conducted, right? Then in case if the person, suppose a person is eligible to file a updated return, what are the tax, how to compute the tax liability in that case? You know that up to 24 months you can furnish your updated return. And in that case, a person, whether he has furnished his return of income or not, are eligible to file the updated return, right? Original updated return. Then how to compute the tax liability while filing the updated return? Section 140B provides for computing the tax liability in that case. There are 2 cases. First, return is furnished. Or first case this, second case is no return furnished. हमने return ही नहीं furnish कर रही है, just you want to file the updated return. Then how will compute the tax liability? अगर आपने return furnish किया, if you have furnished your return of income, then the interest under section 234A will not arise. The late fee charges will not arise. But if you have not furnished your return income, there is a difference. That fee will also arise and interest in the section 234A also arise, right? This is the thing that here you have to pay whatever will be the tax. You have to pay the tax. You have to pay the interest, if any, as per section 234B and C. A will not be applicable. Fee will not be there. In case if you have not furnished your return income, then tax will be there plus interest plus fee, right? This amount you have to pay. So while determining the tax, how will compute the tax? You have to, of course, consider the TDS, if any TDS being deducted, if you have paid some advance tax, if you have claimed any relief under section 989, in case if you have claimed some relief under section 90 or 91, right? So are eligible to claim these reliefs. You are eligible to claim relief under section 90A or tax credit as per section 115J or JD. AMT credit or MAT credit you are eligible. Then you will consider it while computing the tax payable while filing the updated return. Interest under section 234A will not be applicable, where you have 234A will be applicable if you have not furnished the earlier return. Then 234A interest also will be charged. In case if you have furnished the return earlier, the manner of tax payable has to be computed while computing the tax payable while filing the updated return. You have to consider the amount of self-assessment tax you have paid, whatever the tax you already paid while filing the earlier return, the TDS, TCS, the relief under section 90 or 91 DTA relief, and relief the tax credit 115 BJA or 115 JD, which has not been claimed in earlier return. Of course, if you have claimed some relief in earlier return, then you will not be eligible again, right? So though while determining the tax payable in case of updated return, these things you have to consider. Now, these are the things you have to compute. Other than the tax determined on at the time of updated return, that person is also required to pay additional tax. Other than the tax, whatever be the tax on your total income, you are also supposed to pay the additional tax while submitting the updated return. What is this additional tax? Be very careful that how to compute this additional tax. Additional tax has to be computed. Additional tax has to be computed on the amount of tax and interest which you have determined on the total income while filing the updated return. It is not on the total income, 25%. The rate is 25% and 50%. Additional tax is 25% or 50% as the case may be. But that 25% or 50% has to be of in tax and interest amount, not of the total income, right? So when the 25% additional tax has to pay when you are furnishing your return of income after the expiry of the time available under section 139(4) or 139(5), that is 31st of December of the relevant assessment year. The time limit has been expired, and you are furnishing your return of income before 12 months, within 12 months from the end of the relevant assessment year. In that case, the additional income tax would have to compute on 25 at the rate of 25% on the, not on the total income, on the amount of tax and interest, right? Already we determine in case if you are not furnished or not furnished. Both the manners you have to compute the tax on that amount, tax portion, and the interest amount, you will compute the 25% amount. In case when the 50% additional income tax you have to pay after the expiry, if you are furnishing return of income after 12 months, but before 24 months, you have the time limit till 24 months. So if you are paying, submitting your updated return after the expiry of 12 months, but before 24 months from the end of the relevant assessment year, then 50% rate would be applicable for the purpose of determining this additional income tax. Additional income tax has to be computed on the amount of tax plus interest, right? Not fee. Keep in mind, it's a tax and interest. Tax amount will include surcharge as well as cess. Like, for example, like it is similarly like 270A penalty. How you compute 270A penalty? 270A penalty 50% or 200% as the case may be on the amount of tax portion, tax lab payable, right? क्या होगा आपका tax amount? उसके amount पे tax जो भी determined हुआ उस पे it includes surcharge also, it includes cess also. Similarly, here also you will compute the additional income tax. This is the way you have to compute the updated return. So what are the things you have to remember in updated return? The circumstances, of course, are very important. You have to remember the time limits, up to what time you can furnish the updated return, who are the person eligible to furnish the updated return, how to compute the tax and interest amount while filing the updated return, or the additional income tax which a person is liable to pay at the time of filing updated return, right? There is a question which which is given in your supplementary study paper. This is a new amendment forming part of assessment procedure. It's given in your supplementary study paper. Along with the discussion, and illustration is also given in there. This. What is this illustration? This illustration is saying Mr. X would like to furnish updated return for the assessment year 21-22. Assessment year 21-22. 23-24 is relevant for you. But here the time limit is 24 months from the end of the relevant assessment year. Updated return can be furnished till 24 months from the end of the relevant assessment year. Really, here the assessment year is 21-22. Up to what time he can furnish its return of income? Is 31st of March 22. So 23-24 he can furnish updated return. So he has determined that in case if he furnishes updated return, he will be liable to pay 2,50,000 towards tax and 35,000 towards interest after adjusting whatever be the tax and interest paid at the time of filing earlier returns. Here, If he wants to file, you are required to examine if Mr. X want to file the updated return as on 31/1/23, on 28/2/24, and 31/5/24. Then you have to examine, can he furnish his return of income? See, up to 31st March 23, of course, he can furnish because he has a time till 31st of March 24. He has the time to furnish his updated return. He can furnish, yes, he can furnish. Up to 28th February 24, he can furnish. Yes, he can furnish because it is also within the time limit of 24 months. Then 31st of May 24, can he furnish his return of income? Here, no, he cannot furnish. Now you are required to compute the amount of additional income tax payable. In the question, information regarding the tax or interest is given to you, right? In case total income is given, then you have to first compute the tax payable amount or the interest amount. Then you compute the additional income tax. Here that information is given already. So it is coming totaling to 2,85,000 is your tax plus interest amount. If he furnishes return of income as on 31st March 23, then how much additional income tax he has to pay? 25%. Right? If he furnished up as on 28th of February, then he has to pay additional income tax at the rate 50%. Right? Here, he cannot furnish his return of income. So what is the tax liability, additional income tax? If he furnishes, it's 71,250. And in case of second part, it's 1,42,500. Then the additional requirement of the question is asking if suppose in respect of the two above where he has received a notice, under section 147 on 23/7/23, 23/7/23 के respect में he has received a notice. 12 months expired, 24 months he has a time, but assessment is pending. Okay? As proceedings are being initiated, proceedings are pending in respect of him. He cannot furnish updated return as on 28/2/24 because in respect of this assessment year, the proceedings are pending on him. So he cannot furnish his updated return. This is the concept regarding updated return. It's an easy one, right? But you have to remember the time limits, circumstances, and I have to compute the additional income tax rate. These are the three things you have to remember while answering, for the purpose of this provision. Consequent to the insertion of this updated return provision, there is an amendment in section 153 also. What is this 153? Section 153 talks about the time limit for completion of assessment or reassessments. It talks about up to what time the assessment has to be done. 153(1) is specifically because in 153(1), what happens? They are giving you time limit from the end of the assessment year in which your income was first assessable. In that case, since you have already provided a extended time limit of 24 months for filing the updated return, then this time limit will not hold good in case you file an updated return. For that purpose, they have given an extended time limit to the assessing officer for completing the assessments. What are the extended time limit? First of all, you have to note for assessment year 21/22 and thereafter. You have to, remember these in case for assessment year 21/22 he wants to furnish, for assessment year 2021 he wants to furnish. You have to remember the time limits because the time limits are varying for various assessment years. Earlier it was 18 months for AY 2021. From assessment year 21/22, the time limit been reduced from 18 to 9 months from the end of the assessment year in which the income was first assessable. In case if a person furnished a updated return, wants to furnish updated return, then order of assessment under section 143, 144 have the time that they can complete the assessment before the expiry of 9 months. Up to what time? Before the expiry of 9 months from the end of the financial year. Read the words, read each and every line very carefully, and you have to remember also because there is a difference. Here they are talking about that from the end of the assessment year. 18 months and 9 months are from the end of the assessment year. Whereas in case updated return is furnished, the time period of 9 months has to be computed from the end of the financial year in which the return was furnished. Right? Relating to this, this provision, one MCQ is given in your RTP. Let's discuss this MCQ. with what are the time limits for completing the assessment. Two assessments are given in this MCQ. That Mr. Akash has already furnished his return of income for AY 22-23 and AY 23-24 on 31st July 22 and 31st July 23 within the due dates prescribed in 139 when he has furnished. He, however, filed an updated return 139.8A for AY 22-23 on 31/10. He furnished 31/10 को. Now you have to determine the time limits for completion of assessment under section 143.3 in respect of AY 22-23 and in respect of AY 23-24. Now again go to section 153. What are the time limits? First we should determine as per section 153. Forget about updated return, right? Assessment of 22-23 के लिए what is the time is there? It's 31st of when the assessment is ending, 31st March 23 it is ending. So you have 9 months from the end of the assessment year. It's ending on 31st 12/23, right? In case of AY 23-24, what is the time limit you have? You have time limit till assessment is ending on 31st March 24 and you have time up to 31st March 12/24. Okay. For AY 22-23 he has furnished. AY 22-23 he has furnished the updated return. So 23-24 के लिए straightforward. You have already determined the time limit is 31st of December 24. You know it. And for this, it is time limit is 23. But updated return furnished. So what is the extended time limit? He has furnished his return of income in the financial year 23-24 में he has furnished. When the financial year is ending, from the end of the financial year, 31st March 24 it is ending. So he has a time limit till 9 months from the expiry or from the end of the financial year. Okay. Accordingly, it is 31st December 24. The assessing officer has the time to complete the assessment. So for assessment year 20-23, the assessment under section 143.3 can be completed up to 31st of December 24. And for assessment year 23-24 also the same 31st 12/24. So accordingly the answer is option B is correct. In both the cases same time limit is available for completing the assessment. This is regarding the updated return. Now another important provision in assessment process, it is income escaping assessment. It's a newly, by the Finance Act 21, whole sole assessment procedure for carrying out the assessment being replaced, substituted with inserted a new procedure for doing the assessment, income escaping assessment, and the search assessment also are brought into this sections itself. So in case of search is conducted, then also you have to do the assessment under section 147 or by this 151. What is the income escaping assessment? Let's understand what is this income escaping assessment. Again, there are few things what the things you have to remember, right? That when can an income escaping assessment be done? When assessing officer can do the income escaping assessment? What is the relevant assessment year? For what assessment year he can do the assessments? And when the income is said to be escaped assessment, right? Then what is the time limit for doing the assessment? When the notice can be issued for doing the income escaping assessment? And what is the specified authority? Additional condition, that is section 148A, which stipulated certain condition on the assessing officers to do the assessments. Before proceeding with the issuing the notices, assessing officers are also required to conduct the inquiries, to issue a show cause notice that why the assessment is notice can not to be issued on you, right? That also you have to take the approval of the specified authorities for doing the assessment under as per these provisions. So these are the things you have to keep in mind. First, what section 147 says? 147 says, in case any income chargeable to tax has escaped assessment for any assessment year, the AO have the option to assess or reassess such income or recompute the loss or depreciation allowance for such assessment year. He can do. In case income is escaped for any assessment year, then the AO may again assess or reassess, assess and reassess or recompute the losses for such assessment year. This assessment year is referred as relevant assessment year. This is relevant assessment year. Relevant assessment year means the assessment year for which the income has escaped assessment, right? For those assessment year, you have to say whether the income has escaped assessment or not. You have to determine it. You have to check it, right? If it is so, then only he can assess or reassess the income for such assessment years. This is important one. Note it, it is very important that even though assessing officer has issued notice and subsequently while doing the assessment, it has noticed something, some other issue being come to its notice in the course of proceedings, then also he can assess such income in respect of any issue, right? He can do assess or reassess such income, and in that case he need not to comply with the conditions stipulated under section 148A. It is not necessary again to conduct the inquiry, to issue a notice for in with regard to that issue, right? Some issue, further issue is being noticed by the assessing officer, then he can do without satisfying, without going into the section 148A condition. This is important one. Up, that in case income is being assessed for a relevant assessment year, assessing officer can assess, or for the subsequent issue also he can do the income escaping assessment. Then when can an income is said to be escaped assessment? There are certain circumstances they have laid down in section 147. What are these? When it is said 148, here they are saying 148 may they have been given when a notice can be issued. Notice can be issued only when an income is said to be escaped assessment, right? There are two things. Actually information is being suggests that it has escaped assessment, or deeming income is there, deemed to have such information which has escaped assessment. There are two things we have divided. The provision is being divided by way of explanation 1 and by way of explanation 2 to section 148. When the AO is in possession of the following incomes, AO has certain incomes, then that income suggests that it is not being chargeable to tax by in any of the for that assessment year. For in respect of those information, he can do the issue a notice under section 148. What are these information? When any information for that relevant assessment year is being flagged, is being as with the risk management strategy formulated by the board. Some information he has gathered, like in case of statement of financial information from AIS, some information is there, from other agencies some information is there, that some which suggests that certain income being escaped assessment. Some audit objection is being raised, okay, to the effect that assessment already been done, but it is not in accordance with the provisions of the act. In that case also, it is said that information is suggest income escaped assessment. Information is received as per DTAs 90 and 98 according agreements are there. Some information is being received that some income escaped assessment. Some information is available which is being collected in a manner, faceless manner. In that case, section 135 is there, which suggests that in assessing that the assessing officer can collect certain information regarding the assessee. That information is in possession of the assessing officer, and some information is there which requires action. Assessing officer is required to do assessment in consequence to an order of the tribunal or a court. These second, third, fourth, and fifth are the amendments made by the Finance Act 22. Earlier, this one was only there. These 2, 3, 4, 5 are being amended. New things being added to this section. Information such as audit objection, any information as per DTA, any information under faceless collection of information, and any information which you are assessing officer has received for doing the certain action as per the order of the tribunal or the court, right? These are the cases. Then what are the deemed to have information? When an assessing officer is deemed, actually he is not in possession, Abhi, but here he will be deemed to have information which suggests that income has escaped assessment. where a search is initiate, आपको search initiate हो गई है, right? And the books of accounts are requisition of the SSC, then he will be deemed to have information. And survey is conducted again, survey conduct हुआ है, but here again TDS and TCS are, they have excluded. In case if survey is conducted for the purpose of collecting information regarding TCS and TDS, then that will not amount to deemed to have information. And where a money or bullion has been seized or requisition which belongs to the assessee, right? Other person ki case mein search is being conducted or assets or books of accounts are requisition, but it provides some information which is related to the assessee. In that case, the assessing officer is deemed to have information which suggests income escaped assessment. In those two cases, there are differences. That here, in all the cases, 1, 2, 3, 4, 5, except this fourth one, here the assessing officer is not required to conduct the inquiry or to satisfy the condition stipulated under section 148A. Whereas in all other cases, first, second, third, and fifth cases, notice is to be issued for which income is subject to the compliances stipulated under section 148A. 148A means certain compliances has to be done by the assessing officer before issuing the notices. So those has to be satisfied in case of information given in 1, 2, and 3, and 5. Fourth case, he is not required to comply with those compliances. That is conducting an inquiry. He has to conduct an inquiry with the prior approval of the specified authority with respect to information suggesting escapement of income. And further inquiry are required in relation to this information, right? To actually know whether the information that information is correct or not, he has to conduct an inquiry with the approval of the specified authority. Then he has to provide an opportunity of being heard. He has to give a notice to the assessee to whether to show why this notice not required to be issued on you. That kind of notice he has to given to the assessee. Then based on decide on the material available, whatever he has gathered the information based on these inquiries or the reply received from the assessee in response to the so-called notice, they will decide whether it is a fit case for the issuing notice under section 148 by passing an order with the prior approval. Here they have to do whatever they want to do, they have to seek the prior approval of the specified authority, right? So these cases they have to require. Then here in first case and in third case, that is search, or in case of search is conducted or as books of accounts or assets are requisition in case of other person, but some information relates to the assessee, then in case the assessee is not required to again comply with the conditions stipulated in the section 148A. However, where survey is only conducted, then he again has to comply with the 148A conditions. Okay. So here he can issue notice without complying with the 148A in these cases. And in first here deemed information case mein and one information case in fourth faceless in collection of information case mein he can issue notice without complying stipulated condition. This you have to remember, right? Because some kind of question can be issued whether the notice is valid issue, whatever the notice being issued by the assessing officer is valid or not based on these conditions, one question can be asked. Here, AO then again serve a notice under section 140 along with a copy of order. If 148 is required, then he has to issue a notice along with the order which he has issued based on the approval of a specified authority to furnish a return of income within the time limit. With the again, this we will check what is the time limit for issue of notice. What is the time limit for issuing notice under section 148? We will check within that time limit only the assessing officer has to issue a notice for making the assessment, requiring the assessee to furnish the return of income within such period as specified in the notice. Here, this note is related to the fourth information, faceless collection of information, where the information is collected in a faceless manner as specified in section 135A. Here, 148 compliance is not required and prior approval is specified. Authority is also not required. See here, both these two things are required. Here, if you see, यहाँ पे in deeming provisions में you are not required to comply with section 148A in case of search or in case of search is being conducted in case of other person, but survey ke case mein this condition not necessary is not there, which is not given in the provision. But before issuing the notice, he has to take the approval of the specified authority. In this case, 135A may he is not required to take the comply with 148A also. Further, he is also not required to issue take the approval before issuing the notice also. But here, one time he has to seek the approval at least, right? What is the time limit? Important one, very important. Based on this, question can be asked. What is the time limit? Based on this time limit, whether the notice is being issued within that time limit only will make the notice valid or invalid, right? So this time limit is very important. There is two time limits, up to 3 years from the end of the relevant assessment notice can be issued, or beyond 3 years also notice can be issued, but not more than 10 years from the end of the relevant assessment year. In case if AO has in possession books of accounts, documents, evidence, which reveal that the income chargeable to tax represented in the form of asset. Note these one: asset, expenditure in respect of a transaction or in relation to an event or occasion. That expenditure is in relation to an event or an occasion, or some entry or entries in the books of accounts is there, which has escaped assessment, which amounts to 50 lakh rupees or more. Okay. For that, if this condition is being satisfied, then he can go beyond 3 years, but not more than 10 years. What is asset? They have defined inclusive definition they have provided for the assets. That is, assets includes immovable property, land or building, both shares and securities, loans and advances, deposits in bank account. This provision, if the assessment as per the new provisions of 147 to 151 is there, they have to do after 1st April 21, right? So here they are saying no notice shall, it is again important, very important, no notice under section 148 shall be issued at any time in case of the relevant assessment year, beginning on or before 1st April 21. If the assessment year 22-21 is there, suppose this is beginning from before 1/4/21. So here notice cannot be issued if the time limit specified in the earlier provisions of section 140A or 153A or 153C could not have been issued at that time on account of being beyond the time limit specified in section 149 1B or 153 or 153C. Then you cannot issue notice under section these new sections, right? You have to see whether the notice can be issued as per the earlier provisions also in respect of the assessment years which begin before 1/4/21. You have to see this one in RTP. One of the question is there where we have given that 153A time limits is satisfied, then only you are eligible to issue notice under section under this new design. Let's see what some examples. These are being given in a supplementary study paper. These examples in what is a relevant assessment, for what assessment years AO can go and issue notice under section 148. What are this? In case information is there with respect to AY 1780, then can assessing official issue notice? Information is with respect to AY 1780. So we are saying this is the relevant assessment year. Relevant assessment year is 1718. When the relevant assessment year is ending, this is 3 years from the end of the relevant assessment. 3 years time limit you have to see from the end of the relevant assessment year. Right? Here also 10 years time limit you have to see from the end of the relevant assessment year at the time of issuing notice. Here the relevant assessment is ending on 31st 3/2018. So 18 to 19, 19 to 20, 22 to cannot be issued. If he wants to issue notice on 1/4/22, he cannot issue notice under in respect of AY 1718. In respect to AY 1819 also, he can issue, the period is expiring on 31st March 22. He cannot go and issue notice on or after 1/4/22. But for 1922, since 3 years are expiring on 31st of March 23, he can issue notice since 3 years time limit not elapsed from the end of the assessment year, relevant assessment year. For AY 21 and 22, 2021 and 21-22 also he has the time. So relevant assessment year is the assessment year for which income escaped assessment, that is information. If it's information or deemed information, right? You have to see information. If it's simply an information which suggests income escaping assessment, 3 years time limit. If assessing officer has in possession books of accounts and he has in possession documents and which represent some kind of assets or some expenditure in respect of a transaction or an event or an occasion, and both entry or entries in books of accounts for the amount, the income which escaped assessment is 50 lakhs or more. If the amount is 50 lakhs or more, then 10 years time limit is available. Example 2, let's see this example 2. Here they are saying in April 22, business premises of Mr. X and Mr. Y were searched. Okay, under section 132. So AO has in possession certain books of accounts which reveal some information. What are this? In case of Mr. X, it is having documents with respect to which showing that jewelry of rupee 25 lakh pertain to 2015-16 has escaped assessment. This he has purchased some jewelry for 25 lakh. From where he is not able to explain this expenditure, he has not disclosed this kind of income in its return of income. Can he do assessment in respect of this 15-16? See, 3 years time limit already expired. Relevant assessment year is 31/3/2017. So 17-18, 18-19, 19-20. After 31st March 20 already expired. So 3 years time limit already expired, and the amount of that jewelry also not exceeding 25 lakh rupees. In that this 50 lakh rupees, he cannot do issue notice under in respect of this assessment, relevant assessment day. Right? For relevant assessment 11-12, again he has some information relating to some expenditure which he has done for wedding anniversary of 65 lakh. Even though the expenditure exceeds 25 lakh, 50 lakh rupees, it's 65 lakhs. But 11-12, again 10 years have elapsed. He cannot go beyond 10 years, even though the amount of expenditure exceeds 50 lakh rupees, 50 lakh or more. He cannot go beyond 10 years from the end of the relevant assessment. Relevant assessment here is ending on 31st March 2012. So 31st March 2022 only he can go. But now it's 1st April 22. He has to issue notice thereafter only, after doing this search and all. He cannot issue notice as of now in respect to this 11-12. In case of Mr. Y, he has gathered that he purchased some shares in the previous year 12-13 and previous year 13-14, totaling to 55 lakh. There is a provision which is being inserted this year only. This year only they have inserted a provision that where an investment are made and that is spreading over of 2 years, then aggregating of that investment has to see for checking the threshold limit of this 50 lakh or more. Here the shares are purchased in, even though in 2 years the aggregate amount of these shares are exceeding 50 lakh rupees, right? In that case, for both the relevant assessment year, the notice can be issued. Since 10 years time limit has not elapsed from the end of this relevant assessment year, also from this also. This time limit has not expired. So in that case also, Mr. Y case means since it exceeds the 50 lakh rupees or more, the notice can be issued under section 148. Similarly, one descriptive question is also given relating to this. This simple, let's do it hurriedly. That in business premises of Mr. Arjun was searched on 17/4/22 under section 132. Search is being conducted, and consequently the AO is in possession of some documents pertaining to shares purchased in previous 16-17 for 23 lakhs, previous 17-18 for 25 lakhs. 2 years he has information for previous year 2016-17 or 17-18 25 lakhs. What amounts? It coming to 48 lakh rupees. Such contain possession with some books of accounts, so extended time limit of 10 years has to be checked, but along with the limit of 50 lakh or more. Can AO issue notice under section 148 for bringing to test? Agar if the limit is not exceeding, that amount is not less than 50 lakh rupees, then 3 years time limit has to be checked. What is the for assessment previous year 16-17 or previous year 17? What is the relevant assessment year? Relevant assessment for previous year 16-17 is assessment year 17-18, and for previous year 17-18 it is AY 18-19. When they are ending on, their time limit is ending on 31st of March 21. In case of AY 1819, their 3 years time limit is ending on 31/3/22. When the search is conducted, search is conducted on 17/4/22. Now they can issue a notice. 3 years time limit also expired as on this date. So they cannot issue notice under section 148, right? Even within, because 3 years time limit also expired till that date. In second part, suppose the shares value is rupee 30 lakh instead of 23 lakhs. Here the amount is exceeding 25 plus 30 is 55 lakh. Can he do? Can he issue it? Yeah, of course, because 10 years time limit is there for issuing the notice, and the assets value also is more than 50 lakhs or more. Then he can issue notice for this assessment year 17, 18, 18, 19 with the prior approval of the specified authority. Here 148 condition they are need not to satisfy, but before issuing the notice they have to seek the prior approval of the specified authority. In case of second, suppose in what is the given in second, what would be your answer if consequent to search, AO has in his possession documents letting information pertaining to expenditure, some expenditure he has incurred for marriage of his daughter in previous year 16-17 instead of information pertaining to shares. If this is not shares, if it's an expenditure, in respect of expenditure also, that he can go and do the income escaping as under section 147 by issuing notice. But again, see, this is the earlier assessment year, which begins before 1/4/21. What I said that you have to check where in case of search 153A is relevant. In case of search 153A is relevant, where a search can be conducted for 6 assessment years immediately preceding the assessment year relevant to the previous year in which search is conducted. For 6 years, you can do the search assessments, right? It's a search case, so you have to go and see section 153A. 153A may the limit is there. He has the time limit. It's not beyond the time limit which is given in section 153A. So in respect of these assessment year, he can do, since he is satisfying the 153A time limit also. For assessment year 17-18, he can do the assessment under section 147, right? So he can issue a notice under section 140. This is important. You please remember the time limits at least. What are the time limits given? If the assessment year is prior to 1/4/21, then you have to check and see the 153 time limits also. If they are eligible for under these sections, then a notice can be issued under the new regime also, right? So this is with respect to your income escaping assessment. In case if you have any doubt, you may ask, right?
We encourage you to ask more doubts, because what we are taking right now is all those topics which have been significantly amended by the Finance Act 2022 and are very important for May 23 exams. Assessment procedure has undergone a lot of changes. So that's why, so much of time was devoted for this particular topic, because changes have taken place, updated return, 147, 148 time limits for assessment. All those are important changes which in assessment procedure. Please raise your queries so that we can answer it. Then and then. The next comes virtual digital assets. So new provision has come for taxation of virtual digital assets by the Finance Act 2022. So as the name suggests, all the digital assets, virtual digital assets are covered. And the taxability of income is a special provision. They have taken it. It's income from transfer of a virtual digital asset. What is being subject to tax here is, it's already there. It includes from income from a transfer of a virtual digital asset, and it's a special provision. It's subject to tax at 30%. It's not directly come. It's under the special provisions of the Act, and not it is not coming as part of chapter on capital gains or part of chapter on profits and gains of business or profession. It's though it is income from transfer of a virtual digital asset, a separate provision has been introduced, because there are separate, like no deduction is allowed in computing the income. No deduction would be allowed under any provision of the Act in respect of any expenditure or allowance except cost of acquisition. So what is being allowed is only cost of acquisition. So it's a special provision. You don't get any deduction for any expenditure except cost of acquisition. Further, no set off of any loss is allowed from such income. If I have an income, no other loss can be set off against such income. Also, Set off or carry forward of loss on transfer of virtual digital asset is not allowed. Suppose on transfer of virtual digital asset, I incur a loss. That loss cannot be set off against any other income, neither can it be carried forward for set off against income from the same source. That is also not possible. Nor can I set it off against some other income. So both are not permissible. What is not permissible? Neither can I set off loss against some other source against this income, nor can I set off loss against loss from transfer of virtual digital asset against some other source of income. Both are not permissible, nor is carry forward permissible. Expenditures not allowed as a deduction, no allowance under any provision of the Act, no basic exemption limit, nothing can be availed of against this income, no Chapter 6A deduction under any provision of the Act. It's not allowed. Then definition of transfer under 247. 247 contains a detailed definition of transfer, not only sale, but so many other things also constitute transfer that will apply to a virtual digital asset, whether it is a capital asset or not. They are not going into whether your virtual digital asset, whether it's your capital asset or whether it's your stock and trade, whatever the case may be, these provisions, these special provisions will apply in such a case. Okay. Now, taxability of receipt of virtual digital asset. This is first 115 BBH is in the hands of the transferor. If A is going to transfer to B, this section deals with taxability of A. Now, is B also liable to pay some tax? Yes, if it is in the form of a gift. If somebody has gifted me a virtual digital asset and the aggregate fair market value exceeds 50,000, then it will be deemed to be, I mean, I would have to pay tax. It will be my income from other sources, whatever is the value of that consideration. Then if it's for inadequate consideration, even in such a case, and the difference between the aggregate fair market value and such consideration exceeds 50,000, the difference would be taxable in the hands of the recipient. So in this context alone, the fair market value of the VDA becomes relevant. In the hands of the recipient, it is relevant. Okay, but when I'm talking about 56.210, there is a series of exclusions from that. When you get it as a gift from a relative, gift on the occasion of the marriage, so many this exceptions are there. That exceptions will apply for a virtual digital asset also. So this is in the hands of the transferor. It will be subject to tax at 30% without any deduction except the cost of acquisition. No set-off of loss is permissible against this income, and neither is loss from this transfer of virtual digital asset allowed to be set off against any other source. And then for this, it doesn't matter whether virtual digital asset is a capital asset or not. The definition of transfer will apply in such a case. Then in the hands of the recipient, the difference between, suppose I receive it as the gift and the consideration exceeds 50,000, then it will be entire sum will be chargeable to tax in my hand. And suppose it's inadequate consideration and the difference exceeds 50,000, then also it will be taxable. And all the exclusions from the definition of for under 56.210 will apply in the case of a virtual digital asset. If I'm receiving it as a gift from a relative, it won't be subject to tax. Then TDS. Okay. Any person responsible for paying to a resident. Okay. And all these provisions are with effect from 1/7/2022. TDS provision is with effect from 1/7/2022. For transfer of a virtual digit, any person who is responsible for paying to a resident any sum by way of consideration for transfer of a virtual digital asset to deduct tax at 1% of such sum, 1% of consideration. Okay. And at the time of credit or payment, whichever is earlier, this is the rule. Then when will it not be applicable? There are some cases when it's not applicable. If the specified person is an individual or HUF whose total sales, gross receipts or turnover in case of business, it does not exceed 1 crore. In case of profession, it does not exceed 50 lakhs. In the financial year, immediately preceding the financial year in which the VDA is transferred. So suppose now I'm talking about financial year 22-23. For this purpose, I have to consider the turnover of financial year 21-22. And if it doesn't exceed 1 crore in case of profession and 50 lakhs in case of, 1 crore in case of business and 50 lakhs in case of profession, then tax, or if I'm a person not having income under the head PGBP, if I'm a salaried employee, then tax, I have to deduct tax only if the consideration exceeds 50,000. If the consideration is up to 50,000, no tax to be deducted. If my last year's turnover was less than 1 crore in case of business, less than 50 lakhs in case of does not exceed 50 lakh in case of profession, or I don't have any income under the head PGBP. In such cases, the threshold limit is 50,000. In all other cases, the threshold limit is 10,000. So now let's see the RTP question. Mr. Hari, aged 42 years, is a resident Indian who is a salaried employee, and his salary income computed. Computed means all deductions, all expenses. It's a thing which are final result, even after standard deduction has been provided. So salary income is 17,50,000. His brother Rajesh, for aged 45 years, is a resident Indian carrying on retail trade business in which he incurred a loss of 5,25,000 computed for the previous year 22-23. He also trades in virtual digital assets. Rajesh, he carries on retail trade business. He also trades in virtual digital assets. So for him, it is not a capital asset, it's a stock and trade. For Mr. Hari, since he's a salaried employee, the transaction relating to virtual digital asset would be a capital asset. So details of assets transferred by Hari and Rajesh are given. First one is land and building. For Hari, it's only in case of Hari, date of acquisition has been given, cost of acquisition, date of transfer, expenses on transfer, and sale consideration has been given. So he's held it 1/4/2021 to 28/2/2023. So 2 years would be expired. So land and building for long-term capital asset, it should be held for a period of more than 2 years. 2 years period would expire on 1/4/2001 to 31/3/2022, 31/3/23. So before that itself, it has been sold. So it's held for less than 24 months. So it's a short-term capital asset. So no indexation. Okay. Virtual digital assets. So again, they've given the number of units, date of acquisition they have given, cost of acquisition they've given, it is allowable as deduction. Date of transfer also they have given, expenses on transfer they have given. Sale consideration they've given, and FMV they have given for both the virtual digital assets. Now come, person to whom transferred, that is also given. Ganesh engaged in the business of trading in food grains. Balish engaged in the business of trading in furniture. The turnover of the transferee, that is Ganesh and Balish, for financial year 21-22 and 22-23 have been given in the question. Then, during the previous year 22-23, Hari had dividend income of 10 lakh from shares of Indian company. He paid interest of 4 lakh on loan borrowed for investment in shares. Both Hari and Rajesh have deposited 1,50,000 in PPF. Mr. Hari has interest on savings account of 22, while Rajesh has interest on income from fixed deposits of 50,000. Then capital gains indexation also has been given here. Now let's go and proceed to do the computation. See, Mr. Hari, as I said, he is a resident Indian aged 42 years and he is a salaried employee. Rajesh is a resident Indian aged 45 years and he's in retail trade business and trading of BDAs. Let's do the computation before we see the questions, because most of the questions will be answered in that. Okay. Salary. Let me see the case scenario here in front of me. I'm having salary income. It is given, computed 17,50,000. See, 17,50,000 Hari's salary income computed. If it's computed, I need not again provide the standard deduction. So it's 17,50,000. Okay. Now, next is for Rajesh, it is retail trade business in which he incurred a loss of 5,25,000. That again is computed. So they've given you the final figure, 5,25,000 loss. Okay. Now come to the next. Income from transfer of VDA. Now I have to see income from transfer of VDA. So for in case of Mr. Rajesh, it represents, because he's engaged in trading of VDAs. So it's a business income for him. Even though it's taxable under the special provision, you have to categorize it under the respective head. So it's a business income. So VDAs, how do you compute? See, cost of acquisition is given 2,50,000. Sale consideration is given 3,50,000. FMV is given 4,10,000. Expenses on transfer 1,000. First, we know that no deduction is allowable except cost of acquisition. So expenses on transfer is not allowable. Okay. Then what is it? FMV on the date of transfer is relevant only in the hands of the recipient. As I told you, it will be relevant in the hands of the recipient to see whether 56, who are the recipients? Ganesh and Varish. Ganesh and Varish are the recipients. In their hands to see whether 56 to 10 is applicable, we have aggregate fair market value is relevant. Otherwise, in the hands of the person who is selling, only the sale consideration is relevant. There's no provision for adopting the fair market value as the consideration. Like in the case of 50C or 43CA, in case of land and building or where the stamp duty value can be adopted. There's no similar provision to in case of VDA to adopt the fair market value. So in this case, fair market value in the hands of Rajesh and Hari, it's not relevant. It will be relevant for Ganesh and Varish to determine whether 56 to 10 is applicable in their hands. I hope this is clear. So for Rajesh, what we have to see? Now we are seeing the PGBP income. For Mr. Hari, it is capital gains income. For Mr. Rajesh, it's PGBP income. So what matters? My sale consideration of 3,50,000. It is sold in this year, 1/3/2023. Rajesh also, it's sold in 1/9/2022. So, and the period of holding here, it's irrelevant. It is really irrelevant because in case of PGBP, in case of capital gains also, there's no need to categorize it as long-term or short-term capital gains because the provision is anyway coming under 115 BBH. So, there's no need to categorize it. So, how do you compute the business income? 3,50,000 is my consideration, 2,50,000 is the cost of acquisition. Expenses on transfers not allowable. So, it will be 3,50,000 minus 2,50,000 cost of acquisition. So 1 lakh. It's my income from BD. Okay. Now, what about next capital gains in the hands of Hari? There's a capital gain. We've already seen it's a short-term capital asset, land and building, because it's not held for more than 24 months. So there's no question of indexation. It's 30 lakh sale consideration minus expenses of transfer minus cost of acquisition 20 lakh. So it's 30 lakh full value of consideration. 1 lakh is the expenses of transfer. This is 30 lakh. So it will be 29 lakh. Cost of acquisition is what? Cost of acquisition is 20 lakh. So it will be 9 lakh. Capital gain. Short-term capital gain on transfer of land and building is 9 lakh. Now, next you have to see capital gains or loss on transfer of VDA. VDA, again, the same provisions will apply. Whether it's business income or capital gain, the provision is the same, 115 BBH. So here again, FMV is not relevant at all. Sale consideration minus cost of acquisition. Expenses on transfer is also not relevant. So sale consideration is 4,90,000 and cost of acquisition is 5,20,000. 4,90,000 is the sale consideration. Cost of acquisition is 5,20,000. So here there's a loss. So what have we learned? That loss can neither be set off nor be carried forward. This 30,000 loss can be, you can't set it off against the salary income. Anyway, you cannot set off this capital gains against salary income. But even if you can't set it off against 9 lakh also, whether it's a short term or long term, it's immaterial. You can't set it off. It's 30,000 cannot be set off. It cannot be carried forward against any source, any head. I hope this is clear. Now coming to other income. Other income, what is given here? All these are information relevant for Ganesh and Varish and for TDS purpose. Okay, so now Hari has dividend income of 10 lakh. He has paid interest of 4 lakh on loan borrowed for investment in shares. Okay, dividend income is 10 lakh. Loan is borrowed 4 lakh, but his interest on loan borrowed is 4 lakh. But is it allowable? It's 4 lakh is not allowable. It has to be restricted to 20%. Only up to 20% of dividend income it's allowable. So even though 4 lakh has been paid, it has to be restricted to 20% of 10 lakh, which is 2 lakh. So only to the extent of 2 lakh it will be allowable. So the remaining income is 8 lakh. Apart from that, what other income does he have? Both have deposited 1,50,000 in PPF. Hari has interest on savings account of 2,000. Rajesh has income from fixed deposits of 50,000. So Hari has income from savings account of 22,000. So his total income from other sources will be 8 lakh plus 22,000, 8 lakh 22,000. Rajesh has interest on fixed deposit 50,000. Okay. Now we know Rajesh has a business loss of 5,20,000, retail trade business, but he can't set it off against the income from transfer of VDA. That is also his business, but you can't, it's not permitted. Neither can loss on transfer of VDA, which has come here, that cannot be set off against any income, nor any other loss can be set off against income from transfer of VDA, as in Rajesh's case. So you can't set it off against retail trade loss also against income from VDA. So this loss can, however, be set off against interest on fixed deposit, same year's loss. To the extent of 50,000, that loss you can be set off. So here the income from fixed deposit is nil. Now, what is the gross total income here? In this case, it's 1 lakh. That is income from VDA. It's 1 lakh. This 5,25,000, you can't set it off against this. 50,000 has been set off. Remaining 4,75,000 has to be carried forward. Loss. Business loss. I'm talking about business loss of retail trade business here. In this case, what is the total income? 8,22,000 plus 9,00,000, 17,22,000 plus 17,50,000. So it will be 34,72,000. 8,22,000 plus 9,00,000 is 17,22,000 plus 17,50,000. 17, 34,72,000. Now, what is the chapter 6A deduction? In this case, you won't get any deduction because your income represents the income from VDA. So there's no chapter 6A deduction permissible. So your total income will be 1 lakh in case of Rajesh. In case of Hari, 80C, he's invested, both of them have deposited 1,50,000 in PF. But Rajesh will not be eligible because his gross total income of 1 lakh represents entirely his income from VDA. So Rajesh will not be eligible. Hari can, however, claim 1,50,000 because he has income from salary. He has income from salary. He has income from other sources against which he can claim. 80 TTA, interest on savings bank account is 22,000. He can claim maximum of 10,000 in this. So 1,60,000. This is deduction. So balance will be 33,12,000. Is the total income of Hari. And for Rajesh, the total income is 1 lakh. Okay. Now let's talk in the hands of Ganesh and Balish. Ganesh and Balish are the recipients. Okay. Now for Ganesh and Balish, the aggregate fair market value is 5,10,000 here. Okay. And the sale consideration is 4,90,000. So inadequate consideration to the extent of 20,000. Fair market value is higher and he has received it for 4,90,000. So inadequate consideration is 20,000. Here inadequate consideration is 4,10,000 minus 3,50,000, 60,000. Okay. So in this case, it does not exceed 50,000. So there's nothing will be chargeable to tax under 56(2)(10) because only if it exceeds 50,000, it will be chargeable. It's not exceeding, so it's not taxable. Here, it is 60,000 exceeds 50,000. So 60,000 will be chargeable to tax in the hands of whom? In the hands of Mr. Balish. In the hands of Ganesh, nothing will be taxable under section 56. Okay. Now the next thing is, so here aggregate fair market value, if you see the information, it is 5,10,000. We've seen it already, 4,90,000. It's 20,000. Since it's less than 50,000, nothing is taxable, nil is taxable. Here it is 4,10,000 and 3,50,000. So it's 60,000. Since it exceeds 50,000, 60,000 will be chargeable under 56(2)(10). Now we have to see tax deduction under TDS under 194S. For TDS under 194S, here they've given Ganesh. He is engaged in the business of trading in food grains. And they've given the last year's turnover, current year turnover. Current year turnover is not relevant for TDS purposes. Okay, so you can forget about this one. Okay, so last year's turnover, Ganesh also it is less than 100 lakhs. Balish also it's less than 100 lakhs. Business, turnover on business is less than 100 lakhs. So what is the threshold limit for them? If it's less than 100 lakhs, the threshold limit is 50,000. What should be 50,000? The consideration. Here the consideration in this case is 4,90,000. In this case, the consideration is 3,50,000. Both are exceeding 50,000. 4,90,000 also exceeds 50,000. 3,50,000 also exceeds 50,000. So tax is deductible under 194S. Even though the last year's turnover was below the prescribed limit, even then, since the consideration exceeds 50,000. If the consideration had been less than 50,000, then tax would not have been deductible. But both cases, the consideration is exceeding 50,000. So tax is deductible. How much is the tax deductible? Tax is deductible at 1%. Under 194S, 1% of 4,90,000, 1% of 3,50,000. So it is 4,900 and 3,500 will be the tax deductible in both cases. Because these two people are resident, they are paying to resident Indians. Hari and Rajesh are both resident Indians. And so 1% of the consideration, actual consideration. Here again, don't go as per FMB. FMB, what is it relevant for? 5,10,000 and 4,10,000. The FMB figures are relevant only for the purpose of section 56 in the hands of the recipient. It is not relevant in the hands of the transferor. It's not that, therefore, it's not relevant for computation of income of Hari and Rajesh, nor is it relevant for TDS purposes. It's relevant only for the purpose of section 56 to 10. Okay. Now, what is the tax liability of Rajesh? Rajesh, one of the questions is on tax liability of Rajesh. 1 lakh is his income. So 30% of 1 lakh will be 30% is the rate of TDS on income from VDA. 1 lakh represents his income from VDA. So 30% of 1 lakh is 30,000 plus cess at 4% will give you 1,200. So 31,200. Now, this is the tax liability. But if you ask the tax payable, what is the difference between the two? It's the TDS. You already know tax has been deducted. What tax has been deducted? 1% of the sale consideration. In case of Rajesh, the consideration is 3,500. 1% of 3,500 would have been deducted by whom? Would have been deducted by Valish. Valish would have deducted 3,500 while paying that payment. So when I compute my tax liability, I have to deduct the 3,500. I'll be getting credit for the 3,500. So if I deduct this 3,500, my tax payable will be 12 minus 5, 7, minus 27,700. 27,700 would be the tax payable by Rajesh. And the business loss to be carried forward, what is the total business loss? 5,25,000 is retail trade business loss. 50,000 I have set it off against my income from fixed deposits. Income from fixed deposits I've set off 50,000. Total loss is 5,25,000. So balance loss will be to be carried forward is 4,75,000. So these are the computations. Once you've done these computations, then you can easily answer the MCQs. Will hardly take 5 minutes. What is the tax treatment of loss from transfer of virtual digital asset by Mr. Hari? What is the tax treatment of loss? See, what is the loss? Hari's loss we've already computed. Na? 4,90,000 minus 5,20,000. 4,90,000 is the sale consideration. 5,20,000 is the cost of acquisition. Loss is 30,000. This loss, I can't set it off against capital gains on sale of land. I can't set it off against anything, nor can I carry it forward. So that is the tax treatment. It is a long-term capital loss. Treatment loss from transfer of virtual digital asset. It's a long-term capital loss which cannot be set off against capital gain. It has to be carried forward for set off. This statement is wrong. It has to be carried forward for set off. It is a short-term capital loss which can be set off against capital gains on transfer of land and building. No, it cannot be set off against capital gain on transfer of land and building. Such loss cannot be set off against any source of income in the previous year 22-23, but can be carried forward for set off against income from transfer of virtual digital asset. No, you can't carry it forward also. Such loss can neither be set off against any source of income in the previous year 22-23, nor can it be carried forward to the subsequent year for set off against income from the same source. This is right. You can't set it off against income from any other source, nor can you carry it forward to the subsequent years for set off against income from the same source. Okay. What is the income includable in the total income of Rajesh on account of transfer of VDA? Income includable on account of transfer of VDA. We've already seen that. Rajesh. This is Mr. Rajesh. 3,50,000 sale minus 2,50,000 cost. Expenses on transfer not allowed. FMB irrelevant. So 1 lakh is the income included. 1 lakh is the answer. If you deduct the expense of transfer, you will get 1,99,000. If you take the FMB into consideration, you will get the other wrong answers. So you have to take the actual sale consideration. You have to deduct the cost of acquisition. Do not consider expenses on transfer. What is the amount of tax deductible by Mr. Ganesh and Mr. Valish from the consideration paid to Mr. Hari for transfer of virtual digital asset? We've already seen it's 4,900 and 3,500 respectively. So nil in both cases, since their turnover does not exceed 100 lakhs. No, the turnover does not exceed 100 lakhs is right, but because of that, TDS liability is not extinguished. Your threshold, you get an increased threshold. Instead of 10,000, your threshold is 50,000. But here it exceeds the threshold of 50,000. So even though your turnover does not exceed 100 lakhs, still tax is deductible since the consideration exceeds the threshold of 50,000. 4,900 and nil respectively. Since Ganesh's turnover, no, it's not correct. 5,100 and 4,100 respectively. This is wrong. Tax is deductible at 1% of higher of actual consideration at FMB. Nowhere it's given. That is wrong. So it's 1% of sale consideration since the same is in excess of the prescribed threshold limit. Prescribed threshold limit is 50,000. Sale consideration exceeds 50,000. So tax is deductible at 1%. So answer is D. What is the total income includable in the total income of Ganesh and Balish on receipt of virtual digital asset for inadequate consideration? This also we've already worked out. The amount comes out to 20,000 and 60,000, but 20,000 is not includable since it's lesser than 50,000. 60,000 is includable in the hands of the Balish because it exceeds 50,000. So the answer is nil and 60,000. It is only in this case the FMB becomes relevant. The FMB of virtual digital assets is relevant only for the purpose of 56. What is the total income of Hari? Assume that he has not opted for 115 BAC. Total income we've already computed. It's 33,12,000. Hari's total income we've already computed through this process first. So answer is D for this. What would be the tax payable rounded off by Mr. Rajesh for assessment year 23-24? What is the amount of business loss, if any, to be carried forward? Assume that again he is not opted for 115 BAC. This also we've already computed. Tax payable is 31,200. Tax liability is 31,200. Only 1 lakh is the total income of Rajesh is 1 lakh. It comprises only of income from virtual digital assets. So it's subject to tax at 30%. 30,000 plus 1,200. No other loss can be set off against such income. So even though he has a business loss of 5,25,000, it cannot be set off against the income from virtual digital asset. To the extent of 50,000, which was his income from fixed deposit, it was set off. So the loss to be carried forward is 4,75,000. Tax liability is 30,000 plus 30% of 1 lakh plus cess 1,200, so 31,200. From this, we have to minus the TDS of 3,500, which will give you 27,700. So the correct answer is 27,700. Business loss to be carried forward is 4,75,000. Actually, we've gone beyond the time limit. Now the next class has to start. So we will stop with this. So these are the major amendments what we have covered relating to charitable trust assessment procedure and VDA are some of the major amendments through the Finance Act 2022, and they are very important for your exam. Please keep in mind the manner of preparation which we had suggested to you, your time management, the section-wise weightages, and the important supplementary study paper reading is very important. Reading the judicial update is very important. Along with that, work out all the latest MCQs and case scenarios which we've web hosted at the BoS Knowledge Portal. Please take into consideration all these things and wishing you all the very best for your examinations. All the best.